Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 348th VideoCast podcast for the week ending June 18, 2026. Got a lot of great stuff to cover with you this week, but as always, family first. It was another epic week for Annabelle and Mimi. Annabelle turned 12 and got a swim shout out on her birthday for her 1500 being the top swim in the nation. For the 11-12 age group, she had a pool and beach party, and she enjoyed catering from her favorite restaurant, Chick-fil-A, which she got to see, and she got to see Ariana Grande in concert, which has been on her bucket list. Okay. Mimi was away all week with the development national team at June camp. She was in the pool for 8 hours a day, sometimes playing 4 games a day. We sent her video card, and her team celebrated her. Being on the national team has been a dream of Mimi's, so to be with her teammates on her 14th birthday was the epitome of dream realization, and we are so proud of her. So that's Mimi with her amazing development national team. That's Annabelle's birthday cake. There's Caitlin and Annabelle at the concert. And that was Annabelle's time for the 11-12 girls, 1500 free, 1807.96. So super excited for them this week. There's Mimi and Annabelle. Annabelle was visiting Mimi to watch some of her games. This was at the beach party at our house for Annabelle. And that's some of her friends at the pool, and ping pong and food and pool, and that's the whole story. And then this is me at the Big Money Show. Lydia Hu, Brian Brenberg, Dagan McDowell, and Taylor Riggs. This is St. Patrick's Cathedral, where Caitlin and I were married a short 18 going on 19 years in the fall. I got a new friend in the green room at Varney called I don't know what it's called, but it's a robot, and it's Robo Store was the company, and Coid, I guess, is my friend Brendan Ahern's ETF if you want to be invested in robots. Then I did some channel checks on Vans Fifth Avenue, and it was packed both days, which is awesome. They've got some really cool new stuff there. That's on the Varney & Co. Studio, where they record it, to give you a little behind the scenes action. That is the Atlas Shrugged statue across from St. Patrick's Cathedral, where my wife and I were married, Caitlin, and that's on the New York Stock Exchange. Boy, it's been a busy week. That's with Diane King Hall at Schwab Network. Then I did some channel checks on Canada Goose, but it was too late. They were closed, but I did get to see all of their 365 wear. That's been a huge move into growth for them, diversifying beyond $1,000 parkas and everyday wear. That's with my good friend Liz Clayman, who gave me my first break on TV 7 years ago. So great being on with her this week and seeing her in person. That's down at the New York Stock Exchange. More at the New York Stock Exchange never gets old. That's the second day at Vans Fifth Avenue. Just exciting stuff. That's Mike Lee on Mornings with Maria, New York Stock Exchange, and that's that. So let's get down to business. Had the pleasure to join the great Liz Clayman on Monday on Fox Business. Thanks to Brooke Halaskak and Jake Mack. We're going to listen in here.
Tom, let's get to the floor show because we've got a tsunami of market news to talk about with Great Hill Capital Chairman Tom Hayes. Okay, Tom, lots of headlines here from G7 to the war, but also what we see now is a bit of a rotation at the moment in the markets.
That's right. I think what we're seeing since that deal was signed on Sunday, we are seeing rate expectations go down. More importantly is inflation expectations go down. And that's going to help consumer confidence, which, as you know, has been at multi-year lows, and that's tied to inflation expectations. So we're moving into a period, what I like to call the back to the future trade, Liz. And that is, if you remember pre-war, in January and February, the breadth of the market, the participation of a lot of stocks doing well was rampant. And then once the war began, it was confined to a very narrow group of stocks called the AI trade.
Yeah. Just the AI trade.
Just the AI trade. And as a matter of fact, this morning in the Bank of America Global Fund Manager Survey, they called the most crowded trade globally is global semiconductors. People have been chasing that trade. The Intels that were up 5x, the Microns, the DRAM stocks are all up. Those, I think you're going to see in coming months, are going to cool off.
Well, can I just say, look at Taiwan Semi. That's a global chip equipment and chip manufacturing company that every single one of the chip makers really depends on.
Yeah.
I mean, come on, let's be very clear.
Yeah.
Taiwan Semi down 2.25%. Now, quarter to date, we still do have it up 27%.
That's right.
So do you expect all of that will be erased?
I think you're going to see a pullback in that crowded trade that's moved up a lot. And the reason is this. Look, we've seen the hyperscalers. What's happening? Their CapEx as a percentage of free cash flow is 98%. Then they've had to issue debt. Now you're seeing them issue equity. So you have Google issuing $80 billion of equity. You have Meta now looking to issue equity. So as this moves forward, I think the next phase of this, in Q2 earnings, you're going to see a few of these hyperscalers back off on their CapEx commitments. And when that happens, this AI trade's going to cool. So,
the indices will cool off too. And you say don't panic about that. Don't get too concerned.
Don't panic, because underneath the surface in those 493 stocks, you're going to see a lot of those stocks start to rip. And particularly those stocks that have been related to consumer spending are going to start to rip, because as consumer confidence comes off the mat with inflation expectations coming down and hopefully rates starting to come down, we're going to find out a little bit more tomorrow with Warsh, there's going to be ample opportunity in those areas.
Okay, so which names out there are you particularly focused upon?
Okay, Liz, you know me. My nickname is Turnaround Tom, so I've got two doozies for you. These are both down. They fell 80% off their 2021 highs. So you would say, oh my goodness, are they going out of business? Well, no.
Okay, say it, because we got people listening on XM channel 113 in their cars right now, and they're saying, what do you mean these two, Etsy and PayPal?
Etsy and PayPal, both down 80%. What's happened since they've fallen 80%? Their revenues are at record highs. Their free cash flow is near record highs. They're both buying in massive amounts of stock. In the case of PayPal, they're going to buy back $6 billion of stock from their free cash flow this year. Etsy's buying in a ton of stock. Here's the problem. Their margins compressed a little bit. They were massive growth stocks into 2021. Those margins, not only are free cash flow and revenues back at records, their margins are starting to inflect. No one's paying attention. They're trading at record low multiples. PayPal at 8 times earnings, Etsy at 11 times earnings, and the growth is reaccelerating. People aren't paying attention yet. Etsy's up 50% pretty quickly. PayPal is next.
How much do people need to pay attention to the fact from 30,000 feet that we are seeing incredibly high equity allocation in people's portfolios?
Yeah, there's no question about it. And these are some of the things that...
You came up with a chart here that shows it's at the highest point since
2021, which was right before you had a little breather in tech in 2022 in venture, if you remember. So household equity allocation is very, very rich. We saw in recent weeks the amount of call buying on semiconductors and particularly the AI trade.
Meaning bullish.
Bullish was record high. The fact of the matter is, Liz, when dealers are selling that much option premium, it's very rare that retail investors are going to get paid on that option premium buying it up so rich. So I would say indices are going to moderate, driven by the AI trade cooling over the summer. But you can buy these consumer stocks that have been out of favor and make some money while people are worried about their AI trade.
Thank you for coordinating your outfit with mine.
I matched on purpose, just like every time, Liz.
Tom Hayes, thank you very much. All right, the Fed is...
And we're back. And then I had the pleasure to speak to David Asman was in for Stu Varney in studio. Thanks to the great Maggie Edwards, who I got to spend some time with for having me on. Lauren Simonetti was there as always, super excited. Let's listen in here.
Thank you very much for that, Lauren. Well, Thomas Hayes is here with me. Thomas, historically, June is not a great month for stocks, but so far this year is an exception. Why is it an exception? Is it because of what's happening with Iran?
I think so, David. The Iran deal has put consumers and put investors at ease in the short term. I think what we're going to see here moving forward is a back to the future trade. If you remember before the Iran situation, there was massive breadth in the market. A lot of stocks participating, the Main Street stocks, the everything stocks, industrials, consumer stocks were doing well. During the Iran situation, you saw only the AI trade was working, only a very narrow group of stocks. So as we move forward, as this gets inked on Friday, I think we're going to see broad participation in the market and maybe a little breather in that AI trade. So indices could be subdued, but opportunity under the surface, David.
All right, I got to talk about one stock in particular, SpaceX. The shares have surged about 50%. Its market cap is now exceeding Amazon by a tick. Do you regret not having bought into it?
Oh, well, listen, David, I'm going to tell you, if I bought every stock that was trading at 100 times sales in its IPO and losing $5 billion, I would not be sitting here. I would be out of business. So sooner or later, the casino always wins. In the short term, the market is a voting machine based on price and excitement. That's what you're seeing now. In the long term, it's a weighing machine based on fundamentals. There will be better prices to buy SpaceX.
When do you think you would get in? After you see whether or not it gets all the money it's expected to get?
Well, look, there's a trade here into the index inclusion. A lot of people are front-running the buying by the indices. They're going to lay it off to them. You're going to see roll-offs where people can sell their stock and get unlocked. So I think over the next 12 months, if the last 50 large-cap IPOs tell us anything, you have an opportunity in that first 12 months usually to buy it at half off.
Fair enough. Thomas, thank you very much. And you're here for the whole hour. Thank you very much for that. Tom, you've been waiting for a pullback on SpaceX. You may be waiting for a while now, but what about the chip makers? You got any picks there?
We gave Intel on this show between $19 and $21. We actually sold our position at $96 and $97. A lot of great stuff is happening with Intel. We just think that much of it is priced in. So it's run a little away from us. I think it goes lower before it goes higher. As far as chips in general, Bank of America was out yesterday. The most crowded trade globally is global semiconductors. Our bet over the summer as this deal gets inked is that they take a breather.
All right. Thomas, come on back in. You've got a couple of stock picks for us. Why do you like Dentsply Sirona? I think I'm pronouncing that right. I don't know.
Yeah, this is a turnaround Tom special. The stock's down a bit. It's the leading company in dental supplies and manufacturing globally. They've been around since the late 1800s. The stock fell a lot because they did a bad deal. They bought Byte. They overpaid for it. They've got a new CEO, Dan Scavia. He's turning around the company. His last company, he had a four-bagger within his 10-year tenure. He's applying the cost cuts. He's applying the growth plan, return to growth by this year. We like the story. And by the way, the board of directors insiders have bought over $500,000 of shares out of their own pocket in the last week. This thing is going to turn.
All right. The next one is VF Corp. What is it and why do you like it?
Another turnaround story. This is North Face, Vans, Timberland, and Ultra. This is run by Bracken Darrell, a newer CEO. He turned around Logitech. If you had invested $1 million with him when he started at Logitech, in 8 years you had $26 million. He's doing the same playbook at VF Corp. He's delevered the balance sheet. He sold off Supreme. He sold off Dickies, paid down the debt. Now he's back to growth in 3 out of 4 brands. Vans is the laggard. It's starting to turn. Margins are accelerating. This is going to be a great turnaround story for the next 2 years.
So I don't mean to pile on you, but you're avoiding the new companies like SpaceX and going for a company. One of those picks is 160 years old, right?
Yeah, both of them. Yeah, we like durable, predictable cash flows, cyclical businesses.
Okay.
We look for doubles and triples over 3 to 4 years, rinse and repeat, compound money. Compound interest is the 8th wonder of the world. The key is don't interrupt it by chasing shiny objects and losing your money.
You know who you sound a lot like?
I don't know.
Warren Buffett.
Well, I learned from him. He's the best.
He sure is. He sure is. All right, Thomas, thank you very much. Well, Thomas Hayes, thank you very much for the whole hour being here. Appreciate it.
And we're back. Did you catch that zinger when they were asking me about SpaceX? Then I had the pleasure to join the Big Money Show today with Brian Brenberg, Dagan McDowell, Taylor Riggs, and the great Lydia Hu. Thanks to Anastasia Kavunis for having me. We're going to listen in here.
Okay, Tom, I've been reading what all the pundits have to say. We can talk about that, but I want you to tell us what you think markets are saying about this deal.
Yeah, I think what you're going to see here, Brian, is this is a boon to consumer confidence. And we all know all the consumer confidence surveys for the last number of months have been at multi-year lows. Consumer confidence is tied to inflation expectations, and this is a gut punch to inflation expectations. They are coming down, and when consumers have a job and they feel that inflation is coming down, guess what they go out and do? They spend. And what have people been pulling back a little bit on? They've been pulling back a little bit on consumer discretionary. They've been pulling back a little bit on restaurants.
Everybody's telling me those retail sales numbers are awesome, though.
Yeah, retail sales were hot, and Papa John's is up even on that. I know it's our favorite stock.
Well.
Tom, don't egg him on. Come on.
You got that in the first 3 minutes of the show. I love it. I love it.
Brian does love a suck up, so.
Well, there you go.
I do.
Well done.
You know, I think the other thing, with the exception of today, today you're seeing the AI trade is back because the perception was he was a little hawkish, and when you have that risk of slowing through increased rates, money goes into chips. It also went into chips because of the Apple Intel deal, but expect a back to the future scenario in coming months, meaning think back to January and February when you had massive market breadth, market participation across all sectors, Main Street. You're going to see that once again. I think the AI trade, believe it or not, is going to take a little bit of a breather in coming months as everything else starts to get bid now that we have some stability. President Trump chose economic stability over endless conflict.
The more that people talk out about this deal and are like gnashing their teeth and got their knickers in a knot, I think it's like the more people are against it, I actually am like, this is awesome.
Yeah. Look,
I'm not, it's just. Yeah.
President Trump once again pulled a rabbit out of a hat, and no one can believe it, and they're going absolutely crazy. And to your point, you were absolutely right, because if you looked at the forward curve during all of this, forward months were down. To Taylor's point, she's absolutely right. And part of the thing is we got bailed out by the AI trade. That's the only thing that worked during the war. I think we're going to see that cooling. And part of that is so much call premium was purchased by retail investors on semiconductors. And when dealers sell that premium to retail investors, they have to buy the stock. That trade is going to unwind. When you see that much premium written, I can tell you who's not going to get paid. The retail investor's not going to get paid. The dealers are going to get paid. So to your point, equity allocations at the 2021 peak highs.
Yeah.
The call buying is at the 20. So the opportunity is, it's still having a little bit of that fits and starts. It keeps pushing. The unmagnificent 493, January and February, the things that were ripping, go back to that. You'll find bargains, and you'll do really well while that trade is unwinding and people are getting a little nervous.
Okay, good stuff.
Apple has agreed to partner with Intel basically in this foundry business. So Apple makes its own chips. ARM designs them, and they were using TSMC. Now, in part, they're going to use Intel to manufacture that with the foundry business. We had talked, there were rumors about this, I believe, yesterday. But again, the deal looks like this is a bet on American manufacturing, on diversification of the supply chain. If you're Apple, your thoughts?
Super bullish. This is the onshoring trend. The good news is that all this stuff is going to happen. No one believed it at 19, 20, 21 when we were pounding the table at Fox Business. We sold our shares at 96 and 97. Maybe took a little hint from Dagan McDowell here. She's like, let's get out of the stock. I think, look, it's gone up higher. It's probably going to do great. The issue is, are they going to do all these great things? Yes. Is it priced in?
Yes.
Probably a lot of it.
Okay.
So we all listened to the conference, reread the entire transcript, and my colleagues were laughing at me because I said there was an AI LLM Fed model that predicted 85% chance he does not submit a dot, and indeed he did not submit a dot. He's saying, I'm done with forward guidance. How do you think about, sort of all of the ways that he's coming in and trying to rethink the Fed?
Yeah, he's recreating it in his own image and likeness, I guess, as a normal Fed chair would. I think he had to put this message out to say, I'm explicitly independent, and create that message. And you're seeing it today. Bonds, despite the fact he was hawkish, he was clearly hawkish, bonds are up, which would imply dovishness. What that means is people are bidding it because they see that he's not a perceived puppet. The dollar is up because of the hawkishness, so it's kind of a strange response. The market doesn't perfectly know what to make of it. We're seeing a move back into the AI trade a little bit today, a little bit of confusion, but the deal helped get the market up today. So combination of all these things. I do think he's going to be a rational actor. What was surprising to the market is he kind of forgot about the other mandate of full employment. And maybe we take it for granted because we're at 4.3% unemployment. But I do think with consumer sentiment where it is and people having had real concerns about inflation expectations, with real wages, by the way, recently not growing quite as fast as inflation. So that's been an issue. I think he's trying to give comfort to the market, give comfort to Main Street. We're on it. We're acknowledging it. We're going to have a steady economy. And then over time, as we see the inflation come down with oil prices dropping, input costs dropping, then he'll be able to go about the normal business, which is to lower rates and drain liquidity at the same time by reducing the size of the balance sheet. But that wasn't the right message for day one because it would look like Trump wrote his notes.
I do not think that was hawkish at all. Okay. Absolutely not.
I would say this. I'm going to stick to hawkish, and here's why. A flattening yield curve indicates expectations of slowing growth, because when the 10-year yield falls below the 2-year yield, you have an inversion, which basically 100 out of 100 times precedes a recession.
Or no, it can also show that inflation is in check. Longer term interest rates
when you're getting
are
slower growth or meaningfully slower growth. It's a sign of deflation, which is not good for the economy. So I think we're in this kind of Goldilocks. So kind of agree to disagree, but Goldilocks in terms of the economy. But what we don't want to see is we don't want to see the short end of the curve exceed the 10-year yield, because that always points to a real slowdown in the economy, and hawkish policy will create that real slowdown.
But flat is not inverted
yet.
My favorite line of the whole thing, maybe this gets to your point, Tom Hayes, he said, the committee will deliver price stability.
That's right.
He kind of is I don't know if you don't he's kind of tilting away from that dual mandate. I myself think that's a good thing. You guys ought to worry about price stability.
He has brought on an advisor who wrote extensively about that thing, a return to the single mandate of price.
Do one thing and do it well.
Here's the key contrast. Price stability for Main Street, price discovery for Wall Street.
Yeah.
What he's done by taking out the forward guidance is injected a bit more volatility in the market, because there isn't that clear forward guidance with the dots, that now the market's going to have to do it, which is in effect more capitalist.
And
what they're supposed to do.
Chris said this is a return of the central bank to not being on the side of risk takers.
I love it.
And I don't know if the actual risk takers have woken up to that yet.
Yeah.
Chris Wright, Senior Vice President of Advanced San Francisco, this is what he told the SF Standard. The question is about whether a new tax will bring them, grocery stores, back, or whether we should focus more on addressing the underlying reasons those businesses left in the first place. And that's what I think the new mayor is trying to do, reversing a lot of what Mayor London had done before him. So I think City Council and these supervisors can get in over their heads, but I don't think this would actually go through, because he's been doing a very good job of trying to right-size this city.
Yeah, the city's done really well because of the AI trade. It's come back. San Francisco, you could buy office buildings at 10 cents on the dollar about 3 years ago. The AI boom came in. San Francisco's booming in spite of itself, in spite of bad policy, despite bad policies. But when you think about government-based grocery stores, I hate to say it, but we already have it. It's called Jack in the Box. I mean, you pass and for those on the East Coast, you don't really know Jack in the Box.
Love Jack in the Box.
On the West Coast, I like Jack in the Box. It's okay. Every window says, EBT accepted here. So effectively, the government has made a lot of private businesses government grocery stores, whether it's the fast food chains, whether it's the Walmart with the food stamps. So the idea that they can outprice Walmart, who's buying in huge volume, and Kroger, who's buying in huge volume, who've been doing it for decades upon decades, is foolish. I think the system they have in place is correct. If you want to provide a security net, which is fine. Have that money be best spent with efficient purveyors of the desired goods.
So the Massachusetts Port Authority is spearheading this program. They're doing so in partnership, of course, with the TSA and the company that operates the buses, which is called Landline. And Massport says the whole goal here, Lydia, is to reduce congestion not just at the airport, but also on the roads near the airport and across Boston. And so far, they say it's going really well. So maybe it'll show up near you one day, too.
And hey, that is really encouraging. Anything that's going to save us time, I want us to explore. Grady, that is a great report. Thank you very much. So, Thomas, I mean, like I said, anything that's going to potentially save us time, if I don't have to stand with my kids at TSA pre-check line, because even sometimes that can get a little congested.
That's right.
I want to fully explore that. Maybe that could work for us.
I think this is innovative, and I think it probably didn't even take a task force to think of this. They're actually just trying it, and they'll iterate over time, and they'll get efficient. But I think it's a clever idea. I think it saves people time. I also think it saves people money, because parking at the airport, if you do a week vacation or if you take an Uber to the airport with kids and everything else, I think it's going to be very positive. You can park your car out in the suburb and getting in and out. So, I take this flight every single month, United. I go through Clear, I go through pre-check. I'm pretty close to the airport, so it's not a factor. But if I was 30, 40 minutes out, I would probably do this.
Yeah, it seems like
Actually, this is interesting. And I don't like to call these people out. RBC had a $150 price target on Micron until today. They raised it by $675 to bring the price target up to $825 a share. So that's a big 180. But again, the underlying reason is everything we've known. DRAM and NAND memory prices have quadrupled in the last year, and Micron has the pricing power given high demand, low supply. Everyone needs a Micron chip right now.
Poster child for the AI overcrowded trade.
Really?
Oh.
First thing I learned in this business 20-something years ago from a very wise man was opinion follows trend. They couldn't hate it enough at $50. They can't love it enough at $1,100. Micron is the same story every 4 years.
Yep.
Look at the chart. It's very simple. You get a demand shortage.
But this time is different.
They increase capacity just in time for demand to wane. And if you look at their buyers, who are the hyperscalers, what have they done? They've now run out of free cash flow. CapEx as a percentage of free cash flow, 98%. Now they've issued debt. Debt markets have said, we've had enough. We've choked on enough of your debt. Okay, let's issue equity and dilute our owners. $85 billion from Alphabet. Another $20 billion, I guess, coming from SpaceX now. And the next phase is going to be a walk back on some of these commitments in Q2 earnings.
But he still likes Papa John's, Lydia.
Thomas
I still like
Hayes,
Papa John's.
That is why you're here. Thank you so much for being with us for the hour. Well done.
And we're back. And with Liz talking about PayPal. Then I was on Mornings with Maria. Lauren was in for Maria. That's my friend Mike. And we're going to listen in. I want to thank Cassie Loloff, Lauren Simonetti again. Let's listen in here.
Time now for the word on Wall Street. Top investors watching your money. Joining me now is Great Hill Capital Chairman and Managing Member Tom Hayes. Also with us is Mike Lee. Tom, welcome to this hour. I want to start with you here. We got futures way up. I mean, we have the Dow soaring just about 500 points here in the pre-market. Nasdaq's up 630. Oil prices down 5% as President Trump finalizes a peace deal with Iran that would open the Strait of Hormuz. Start your engines, the president said. Kepler says over 500 large commercial ships are currently trapped in the Gulf. This deal would mean they could eventually get out. The Pakistani prime minister says the official signing ceremony will happen on Friday. That would be in Switzerland, which the commander-in-chief also confirmed. Look at this. Airline stocks soaring. More crude, more jet fuel is coming to the market. So you can see huge gains in the pre-market. American up 4.5%. Thomas, what's your reaction to all of this? I mean, we could have a peace deal this week.
Yeah, well, President Trump did it again. He pulled a rabbit out of the hat. This is really, really good news for markets. This is really good news for the economy, because what you see here is equities up, rate expectations down, inflation expectations down. You know, one thing we've been struggling with is consumer confidence has been at multi-year lows. This is going to be the inflection point as inflation expectations come down, consumer confidence comes up, and we're going to go to the back to the future trade. If you remember pre-war, January and February, the broadening, the breadth of the market, the participation of the unmagnificent 493, that's what we're going back to. So if you've made a lot of money in the AI trade in the last 8 to 12 weeks, because that's all that's worked during the war, now you have an opportunity to buy some of the other stocks that have been left for dead, and that's the real opportunity. Focus on the consumer, focus on rate sensitive, and then we got to pay attention to what Kevin Warsh is going to say on Wednesday.
Yeah.
With this deal, it gives him the latitude to be balanced.
Hold that thought, because markets finished higher. We're going to get to the Fed in a second. But, Mike, I want to bring McGuff called them the lag 7. Tom, I want to get you in again. Take a look at yields this morning. You can see they're sharply lower. Kevin Warsh is set to lead his first policy meeting as Fed chair. That's tomorrow. Markets are pricing in the possibility of a rate hike this year, but you know, we'll see what happens. The chance for a rate hike in December is down to 50%. It was at 60% on Friday. How do you see it?
2 weeks ago, it was at 77%, down to 50. By December, that will be 0. I would bet, and I was saying this 2 weeks ago when it went to 77%, my odds are on a cut before the end of the year. Look.
A cut.
Housing is 18% of GDP. We've got to refinance a lot of debt. He can reduce the size of the balance sheet, drain liquidity, cut rates because this deal is done, because oil prices are coming down, because inflation expectations are coming down. I think you're going to see him balanced. He's going to show independence on Wednesday. He's going to say if the data supports it, we'll hike. If the data supports it, we'll cut. He'll be very balanced, and then he's going to work to cut before the end of the year.
But, Mike, he also wants less talking by Fed officials, less information being sent out to the press. And look, you had, 4 dissents at the Fed's April meeting. How is he going to handle it?
Well, you know, hopefully some of those dissenters have new jobs. With the Supreme Court coming down the pipeline. But look, I am 100% with Tom here. I think over the course of the next few months, you're going to see those odds change in the Fed watch to the chances of a rate cut. Okay, and once that rate cut conversation comes in, look out for stock prices because we are going significantly higher.
I mean, do you think the cut, guys, would happen before the midterms in November?
Well, he's not Jerome Powell.
Unknown. Let's see what happens to inflation expectations. But before the end of the year, I think these odds are going to flip. 50% chance of a cut before the end of the year.
All right, Thomas Hayes and of course Michael Lee. Thank you very much. Coming up, President Trump vowing.
And we're back. And then this was really interesting. So Phil Rosen has a podcast called Full Signal. And he works for Anthony Pompliano at their firm. And I didn't know if I was going to squeeze it in. I had a lot of media hits and business meetings this week in the city, and we made it work. And he was flexible with his timing. I got to tell you, this is probably the most important 42 minutes of the podcast this week because he really asked amazing questions to help people understand our investing framework and why we do what we do and how we do it and why it works over time. So you're really going to enjoy this special treat from Phil Rosen. Listen in here.
Tom, it looks like we're getting this peace deal with Iran here. What are you watching for these next few months as far as asset prices?
Yeah, Phil, first off, thanks for having me on. My theme for the coming weeks and months is the back to the future trade. If you remember, prior to the war, January and February, market breadth, stocks under the surface, so much participation. The unmagnificent 493, every stock was going up. Main Street cyclicals, industrials, consumer, the whole thing. The second we started in Iran, and inflation expectations picked up dramatically because oil prices went up. Consumer confidence went down because that's directly tied to inflation expectations. The market narrowed. The market narrowed by a record amount to one trade, which you know very well, which is the AI trade. So the only thing that worked during that period was semiconductors and anything related to AI. And we saw many semiconductors, one of which, we owned, we were talking about, which was Intel. But we were buying it 2 years ago and no one wanted it at 19 and 20 and 21, and we had to wait. And then all of a sudden this opportunity came and, it went from 20 to 96. We took it off. Now it's 120, if you can't take a joke. But the key theme is that we expect the market to start to act the way it acted before the war is over, once the deal is signed, which means what Bank of America Fund Manager Survey said on Tuesday, global semiconductors is the most crowded trade in the world by far. We think that trade is going to cool off, which will have probably some weight on the indices, because tech and AI related is almost 40% of the weighting of the indices. And so while the indices are subdued, a tremendous amount of money can be made under the surface, because what's going to happen is money will move from what was perceived to be the only trade that could work in the face of high inflation expectations during the war to everything else that can start to work, and people looking at value versus price. And starting to look for, what am I paying? What am I getting? And that's the unmagnificent 493, where you can find real bargains and buy cash flows at discounted prices and predictable recurring businesses, and not just chase the shiny objects.
So just to get this right here, post-conflict, we can expect to see non-AI stocks picking up. Is
Correct.
That like the summary?
That's right. That's right. And I think it will be partially skewed in favor of the customer, what's related to customer sentiment. As you know, consumer confidence is at multi-decade lows, and that has a super high, if not perfect, correlation to inflation expectations. So as that come down, we saw this morning, retail sales were still strong. People still have jobs, but what's in the gutter? Restaurant stocks are in the gutter. Consumer discretionary is in the gutter. To a lesser extent, if you remember the first 2 months of this year, consumer staples were flying. You can't give away a consumer staple. So what does the diminishing of inflation expectations also do? It's going to start to slowly increase the odds of a rate cut versus a hike that's priced in now. Once you have expectations of a rate cut, anything with a yield, whether it's REITs and or dividend paying stocks, most of which are defensive like healthcare and staples, will get bid. There'll be a demand for yield as rates start to come back down.
If we start to see a pickup in, let's say, staples or more defensive plays, do you think that can happen while the AI trade keeps going up, or you think it's going to be, one going down?
I think it can happen while the AI trade consolidates sideways or goes down. I think it's unlikely for that to happen if the AI trade persists, because if the AI trade persists, it's interesting. Yesterday, you saw semiconductors got smacked. Okay. This morning, when Trump said, well, we have an MOU. If I don't like it, I'm going to start shooting at them and dropping bombs on their head. Immediately, semiconductors got bid. Then there was talk, like later you saw the MOU, the 14 points started getting leaked everywhere. Semiconductors cooled off again. So it's like, if we have no deal, get back or stay with the with the AI trade. If we do have a deal, I think that some of that money is going to come out and it's going to start to go aggressively into other parts of the market.
It sounds like if you've been riding semiconductor ETFs, let's say, or if you've been riding Micron or South Korea, time to get out of those, because I think we're going to get this peace deal.
Yeah. Look, we got out of Intel early, $96, $97, but we're okay with that. We don't need to be pigs. We take the middle out of the sandwich. We leave the crust for everyone else.
I love that. Okay. How much of this thesis of yours is just sentiment, or is it also tied to something you're seeing in earnings?
It's partially overcrowding positioning. I mean, when you see that much premium sold to retail investors on one theme, odds are dealers are going to get paid and retail is not. And you've seen volumes like that unseen since the 2021 peak, the meme trade peak, and the tech peak before you saw some weakness in 2022. We're not calling for any of that type of weakness, but I do have a framework which is unpopular, that, and we kind of have been talking about the possibility of this for some time, and now it's happening, which was CapEx as a percentage of free cash flow for the hyperscalers now approaching 98%. So what have they had to do? They've had to issue a lot of debt. Well, debt markets have become more complicated. So now what? You've got issuance of equity like Google did, 85 billion, diluted their owners, albeit at a high valuation. So it's less punitive, but they still screwed you. If you own a slice of pizza, your slice just got smaller. Your slice of ownership in Google got smaller. Meta is doing the same thing. And I think the next phase of that, because if you've used up your free cash flow, you've gone you've issued a lot of debt, in terms of the leverage that you want to take on. Now you're issuing converts, and then you're doing straight equity. Your next step is, and I think you're going to see it in Q2 earnings, and that's what spooked the market yesterday about that Microsoft pulling out of the Oracle deal for quote unquote security. Like, you really think there are security concerns with Oracle? Like, this is not some like corner bodega. Like, Oracle understands security. This is what I think is going to take place is some of these hyperscalers are going to back off a little bit on their CapEx commitments because investors are getting impatient with not seeing the return on invested capital, which is coming. It's just it won't come fast enough for investors. And I think it's going to give you an opportunity to buy that AI trade in the fifth inning at lower prices ahead of the election, just not today.
So it sounds like you are not super near-term bullish on the Mag 7 as a group. Is that right?
Yeah, I mean they've been the lag 7, so they've not performed well, with the exception of Google, and I think the only other positive one was Microsoft, which is also starting to lag a little bit. Yeah, I'd say certainly agnostic there. I wouldn't necessarily be a buyer, and semiconductors and memory, I think you're going to see some profit taking.
If you already own, let's say, a Google, NVIDIA, a lot of the investors I speak with, those are their biggest positions.
Yep.
Would you be a seller here, or you're just not buying at these levels?
Depends your basis. It depends your time horizon. So, if you own the thing for 10 years, do you care if you get a 20 or 30% pullback in the long term? No. I mean, like, the demand should go up over time. If you own it, because you just bought it in the last 3 weeks because your neighbor bought a new car because he bought Hynex or whatever the hell is going parabolic, or Micron. A funny story about Micron. What's the thesis? Oh, it's trading at 3 times earnings. Okay. So it's trading at 3 times peak earnings. Because if you go back and you look at the Micron chart for the last 30 years, every 4 years you have the exact same story. You have a shortage, they build out capacity just in time for demand to diminish. And then you have overcapacity and Micron corrects. Like, this is like, so somehow people think this time is different than the last 50. And like, there's a salient argument to be said for like AI is different. Like, this is unlimited demand, and it is going to be a secular trade. I think that, what you're seeing in terms of token pricing and the way people are using it, and the way that engineering can adapt for situations, 2 years ago, all we could talk about is training the LLMs. And then we were like, wow, GPUs are too expensive. All of a sudden, the game became inference. And now we could use CPUs, and Intel became a player. And everyone thought it was only going to be NVIDIA forever and Taiwan Semiconductor. Now Intel has fabs. So the world adapts. And I think it's pricing in the perpetuation of something that's unsustainable. I mean, you've seen the parabolic moves, you've seen the overlays. I don't think this is 2000. I think it's probably 95, like fifth inning, but there were a lot of breathers between 95 and 2000.
Today's episode is sponsored by Public, and they just launched a new product called Agents, and it's honestly one of the most compelling uses of AI in investing I've ever seen. The idea is simple. A lot of investing is repetitive. Monitoring markets, moving cash, managing risk, rebalancing positions. It's the kind of stuff investors constantly have to stay on top of. Public's new Agents product lets you automate those workflows using plain English. So instead of manually watching charts all day, you can create an agent by typing something like, if the VIX hits 25, buy a weekly put option on SPY. Or if my cash balance goes above 20,000, move the excess into my direct index. Public's AI then turns that into an automated workflow that you can customize, review, and activate directly in your portfolio. Public is essentially building what they call an agentic brokerage, a platform where AI can help automate the operational side of investing based on rules and strategies you define yourself. If you want to start automating ideas inside your portfolio, visit public.com/openingbell. That's public.com/openingbell. Now let's get back to the show. I will say I talked to a lot of people last year when Micron was already making its parabolic move. Yeah. They were saying then, time to get out of the stock.
Yeah.
And that was, 500% ago.
Yeah.
Does that make you nervous or?
No, because things overshoot on the upside and things overshoot on the downside. So we like to buy stocks that overshoot on the downside and help people out when they overshoot on the upside and everyone wants it. And look, thing about this business is there are a lot of ways to make money. And everyone thinks that their way is the only way. I'm of the minority. I don't think my way is the only way. I think my way is the only way for me and my clients because it works for us. Okay. But there are plenty of people that make money chasing momentum. There are plenty of people that make money buying breakouts. Thing about that is that's more trading on price, which is based on short-term emotions, versus value, which is the long-term weighing machine based on fundamentals. So one school of thought chases price because everyone's chasing price and they just hope people will come in after them and they could care less about valuation. They're just on the wave, they're surfing, and they just want to get off the wave before it crashes. And very tough to do with large sums of money, or if you intend to build a business with large sums of money over time. But when you're buying companies that have durable, predictable cash flows, you can build a very large position over time. And then when everyone else gets interested and it re-rates and there's a catalyst for change, not just cheap for cheap's sake, but cheap with a catalyst and a turnaround, not only can you get in and build a large position at reasonable prices and bring your basis down over time, but when it does inflect and it makes its move and everyone gets excited about it, all of that liquidity works to your favor as well. So when the sell side, who is, downgrading Alibaba at $60 and upgrading it at $190 and creating liquidity for you, because opinion follows trend, it's perfect. Because when everyone wants it, you need that liquidity to get out.
That's a super smart way to think about it. If we're at this turning point, according to your thesis, where AI slows down, consumer staples maybe pick up,
and discretionary.
Yeah. Is the way to play that for someone who's not in the weeds, just buying those sector ETFs?
That's a great question. I've always shied away from ETFs because when people think of me, they're like, oh, he's a value guy. And then you overlay our returns on a value ETF and there's zero correlation. So it's like, okay, I think I'm a value guy too, but value and growth are attached at the hip. But the more I think about it, I'm not. I'm turnaround Tom. I buy businesses that are really out of favor with a catalyst, that have predictable cash flows. And some of our cheapest stocks that we've ever bought were trading at 100 times earnings. Why? Because they were trading off a trough earnings. And that's why most value investors miss it. They screen for multiples or whatever. And the fact of the matter, if normalized earnings is $2 and you're in a recession and earnings go down to 2 cents for a few quarters, guess what? You're trading at 100 times earnings, but on normalized, you may be trading at 10 times. And your bet is that this is what happens every recession, or this is what happens every time consumer staples go out of favor. Consumer staples today, Phil, are the most out of favor relative to tech in 26 years. And you haven't seen a setup like this since 2000, when Warren Buffett was on the cover of Barron's and Fortune magazine, and the theme of the headlines were, has Warren Buffett lost his touch? And Warren Buffett was buying Procter & Gamble and Coca-Cola in 2000 when everyone else was buying Enron and WorldCom and Cisco and Amazon and Intel and Oracle, the usual suspects. And the interesting thing about Amazon that reminds me of some of the stuff that's going on today, it's not a perfect parallel, is that, so by the way, how the story ends is over the next 2 years, the NASDAQ dropped 80%. Buffett had 3 of his best years of performance because staples went up. Amazon in 2000 was saying they were going to become the store of everything. And they were selling books at the time on a Web 1.0 website, rinky-dink thing. Not only did they become the store of everything, they then added Prime. They then added Amazon Web Service. They then added the ad business, which, by the way, is 60% of their operating income. Most people don't know that. They did way more than they promised. Okay, so people were excited about the stock in 2000. They exceeded expectations. The problem was price versus value. In 2000, you were paying as if all of the things that they said they were going to do were already done. Problem is it took 15 years. So in the meantime, from 2000 to 2002, Amazon stock dropped 90%, peak to trough, while at the same time the stock dropped 90%, revenues increased every year, earnings increased every year, free cash flow increased every year while the stock was going down 90%. Why? Because you were paying for stuff that would come 15 years from now as if it had already happened. And guess what? Stock took a decade to get back to its high watermark. So it's something to keep in mind when, Varney asked me today on Fox, or David Asman was sitting in for Stewart. They said, do you regret that you didn't buy SpaceX? And I said, if I bought every IPO that was trading at 100 times sales, I wouldn't be sitting here because I'd be out of business. And I remember this story 4 years ago, Airbnb. I mean, one of the hottest IPOs, the thing went parabolic, and I'd go on, I'd be like, yeah, I'd pass on this one. People are like, are you out of your mind? They're changing the world. Like, this is a whole new business model. And it was. And now the thing's down 80% off of its IPO peak or whatever it is.
You say all this and you bring up Buffett in 2000, you bring up the consumer discretionary back then.
Well, he was buying staples more than discretionary back
Staples.
then. I'm a little more bullish, so I'm adding in discretionary.
Fair enough.
Yeah.
Is it a leap to say you're expecting the top of the AI trade soon?
No. I think we're mid-innings. I think what we're going to do is get a cool down that people say it's the top of the AI bubble, and we'll be in buying it like we were buying Amazon and Google in 2022 in the fall when you couldn't give away a tech stock when they were cut in half.
How close is that to right now?
We haven't had a correction yet. So, I mean, in terms of time, I don't know. But I think somewhere over the next 6 months, probably before the election, I think some air will come out of that trade.
Okay. I think, I guess that would generally align with midterm cycles, the weakness there.
Correct.
Okay. So, Tom, I want to ask you specifically about a name you shared with me before this, PayPal.
Yes.
No one else is talking about PayPal right now. It's pretty out of favor. Why do you like this stock?
Yeah, so this stock fell 80% off its 2021 highs. So the last kind of period where there was over exuberance, retail call buying on individual stocks. This was the top of the last cycle. Fintech, everyone was excited about tech, venture capital, meme stocks, a lot of option buying. You couldn't get enough of PayPal. I think it traded up to 30 times earnings, whatever. So fast forward 3 years later, what's happened? Stock's down 80% in price. Revenues are at a record high. Free cash flow is just about a record high. Earnings are at a record high. Share count is at a record low. They've bought in 15% of the stock per year. They're going to continue to do that. They'll buy back $6 billion of stock this year alone from free cash flow, by the way. And the issue was, as it was growing into that story in that time period, margins were expanding. What happened between then and now? So all these things I say are good. Record revenues, record cash flow, record earnings. Well, what's not a record is margins. So they had some margin compression. Why did they have margin compression? So everyone thinks that PayPal had margin compression because you pick up your phone and you see this thing called Apple Pay, and you see this thing called Google Pay, and you don't see this thing called shiny PayPal button anymore, okay? So branded has grown, but grown slower than the part of PayPal that no one even realizes exists, called Braintree. Okay. So have you taken an Uber in the last 2 weeks?
Yes.
Okay. All of those, you're paying PayPal. You don't even know it. Have you done a DoorDash in the last 90 days? Okay.
Yes.
You're paying PayPal. You don't even know that. Have you gone to a concert and used Ticketmaster in the last few months? You're paying PayPal. You don't know it. It's what they call unbranded checkout. They do 1.7, not billion, trillion dollars of transactions per year. They have 90% of the Fortune 500 companies using their payment systems. So naturally, that business, which is lower margin, has grown much faster than the higher margin business, which is branded, which is like you and I, we log into PayPal and Venmo. Venmo, by the way, is growing at 20% a year. They've got it in all the colleges with debit cards, with the football logo on the debit card, with massive rewards, the whole thing. Every time you gamble on the golf course, no one has cash anymore. Pay the caddy with Venmo. You pay, if you lose, you pay with Venmo. If you win, you give them your Venmo account. Depends how you putted that day. And buy now, pay later is growing over 20%. So what happened is, because Braintree grew so fast and branded grew at a more modest pace, but still grew, the margins contracted. The margins in the last 2 years have started to inflect back up. No one's paying attention. It's still trading at 8 times earnings. You can't give it away. There's a hidden asset that no one's paying attention to besides all those things that I told you about. It's called the ad business. And there's a guy named Mark Grether that came in about 1.5 years ago. Mark built from the ground up the ad business for Amazon, which is a $63 billion business, by the way. And that runs at 75 to 80% margins. It's responsible for 50% of Amazon's operating income. Most people think they get a stapler in the mail and they get their deodorant and they get all this stuff, and that's how Amazon makes all their money. That's not how Amazon makes all their money. They make it from AWS and they make it from the ad business. Most people don't know about the ad business. So Grether got, huge success with that. He decided, I'm going to go to Uber and do the same thing. Within a couple of years, he built a couple $1 billion business for Uber at 75% margins. PayPal, with 439 million users, and 25 plus years of data. They don't just know where you searched. They know what you buy, when you buy, how you buy. They have more data points, maybe close to Amazon. We're not looking for a $63 billion or whatever business. Certainly more, orders of magnitude more than Uber. If they just did the Uber-sized business, even though they've got 100 times more data and it could be 100 times bigger, that's $2 billion at 75% margin, adds $1.5 billion of free cash flow to the business. They're doing $6 billion. So that's nice. We like cash flow, but no one else seems to like cash flow. Here's the biggest part about it. That's a 75% margin business. Do you know what that's going to do for overall margins on the business? It's going to double them. And when it doubles them, all of a sudden the sell side, who hated it at $38, is going to start liking it at $75. They're going to love it at $100, and they're going to be doing cartwheels at $150. And when they can't help themselves and they're doing double upgrades at $150 and everyone wants the stock, we're going to help them out because they create the liquidity for us. And we're going to give out all the stock that we have. But in the meantime, every time they do these ridiculous downgrades, when they're growing free cash flow and the stock goes from 55 to 45 to 38, we're buyers.
Wow.
That's it.
It's a great thesis.
That's the whole framework.
You certainly know how to pitch a stock. So all of that sounds extremely bullish.
Yep.
Why is no one else talking about it?
Because that's the way it always goes. Because what happens is when the number one thing I learned at the first hedge fund I worked at was a phrase called opinion follows trend. And you've heard Buffett say, in the short term, the market is a voting machine based on emotion. It's all about price, chasing price. So if price is down, it must be bad. If price is up, it must be good. Doesn't matter if it's 100 times sales and losing $5 billion of money, it must be good. The price is going up. the market's telling me something. The market's telling me. The tape is telling me. Tape's not telling you anything. What it's telling you is where sentiment is at the moment, a demand for a finite piece of paper. Unrelated. Now, in the long term, it's a weighing machine. And what's the weighing based on? The weighing is based on fundamentals. And people say, well, so what? How do I get my money out? It's doing so good, but the price is down. Without equivocation, 100% of the time, price will catch up or catch down to the underlying fundamentals over time. I cannot tell you when, which is why we own 8 to 12 stocks versus one stock. But what I can tell you is across a portfolio of 8 to 12 stocks, some like Albemarle we were talking about, triple way faster than we expected. We thought that was going to take 5 years. It took 1 year. Other stocks like Intel, we bought 2.5 years ago when no one wanted it. And you remember 19, 28, back to 19, grinding at 20 for another year. It doesn't matter. The intrinsic value was there, why we had done our work. So we didn't get out at 96 or 97, some arbitrary number, because we just thought we should. We knew where we were getting out before we ever got in. We just didn't know how long it was going to take. Because we knew that if they liquidated the whole damn thing when everyone says it was going out of business 3 years ago, book value was $22. We would have made a couple bucks, okay? So that our downside was protected. The legacy CPU business, which no one wanted, which is a cyclical business usually based on computer sales, was worth $45. So we knew we had a double if they didn't go out of business, if they didn't liquidate the company. And God forbid they did something right. And all the fabs that Gelsinger was building, which the board told him to do, and they got impatient because the price was down. So they kicked him out. He was the virgin, sacrificial virgin. They kicked him, even though they told him he could do that. So he laid the field. He took the ball down to the 10-yard line. They cut his throat. Lip Bhutan comes in, takes the football at the 10-yard line, walks it over the touchdown, and spikes the football. $100 stock.
You make it sound so easy. Tom, tell me about this stock Etsy. This is another one that you're very bullish on, and it's actually had a pretty decent run the last few months.
Yeah. The higher it goes, the less bullish I'll get. But it's had this nice move, but we've been in it for a while, and this is the exact similar type story to PayPal. It was a 2021 darling when everyone wanted it. Fell $80, 80%. We love buying stocks that are down 80%, provided first thing we do is solvency risk, okay? So stock that falls 80%, usually people think it's going out of business, okay? So we look at the balance sheet. Are they going out of business? No, they had no balance sheet problem. Their debt is very reasonable levels, same with PayPal, $10 billion of cash. If anything, they were generating too much free cash, okay? So sometimes market loves stocks that lose money, that have a good story. Other times the market likes businesses that actually make money and are predictable and have been around since 1899. I'll give you a few of those if you like. I like companies that have been around for 100 years. But so Etsy, similar story. They had all the growth going in. The growth in users kind of leveled off a little bit, but still modestly growing. They had a couple other businesses, Depop, et cetera. And margins contracted a little bit, user growth stalled. So the stock didn't grow consistent with the stalling 1 or 2%. Stock said, oh, you're not growing up 10% a year, therefore you're going down, and you're going down 80%. But over the same period, guess what was happening? Free cash flow was growing, earnings were growing, revenues were growing. Oh, and by the way, they were buying in stock. So what that means is I bought this slice of, if you have a pizza with 8 slices, they would buy in stock, and my slice, they would buy in all the other slices. My slice kept getting bigger and bigger and bigger. My slice of the earnings ownership without me putting another penny in the stock. Okay. So every time it went down, we would buy some more, and guess what's happening now? So they sold off Depop. They got a new CEO. So that's number one, solvency risk. Number two is leadership. Who's the jockey I'm betting on? Most stocks that fall 80%, you generally don't want to hire the arsonist to put out the fire. So you kick them out and you get someone new. So that's exactly what they did at PayPal. That's what they're doing now in Etsy. Okay. So the girl who ran Depop, which was their fastest growing business, which they just sold for $1.2 $1.2 billion to eBay. She was a growth machine. She's now running Etsy. Growth is coming back. Margins are inflecting. I always say, look, if you want to get someone a gift, go to Amazon. If you want to get someone a gift and make them feel special, you go to Etsy. You get these handmade things, they're custom. People feel like you actually put some thought into it. And there's nothing else like it. So it's a special marketplace. It fell with all, PayPal fell with all the payment processors, Fiserv, Global Payments, et cetera. Because why? Because of Wall Street Fashion Show. It's like Baskin Robbins. Baskin Robbins, every week they have a flavor of the month, whatever they have. That's how Wall Street works, as you know. They'll be, by the way, 2 years, I don't know if it's 12 months out or 36 months out, you'll see it back on the flavor of the month.
Again, this is another stock that I haven't heard anyone talk about, Etsy. One question that comes to mind here, Etsy has built a brand basically saying you can find things here you can't find anywhere else.
Yep.
It's all custom items, a lot of sort of user-generated content products. I see a lot of stuff about AI agents doing shopping, and increasingly they're going to be doing shopping for people.
Yep.
I don't know what percentage that is now. Does that sort of commoditize what Etsy is trying to do?
It's the opposite. They actually, both PayPal and Etsy are ahead of the curve on agentic shopping. They already have relationships with OpenAI, with Gemini. So they're at the forefront when people are, because at the end of the day, you still need a platform where custom stuff is made, and Etsy's become that platform of sellers. So whether they go to Etsy.com or their app, which they've done a really good job of like incentivizing people to use the app and getting user engagement up. If someone just says, I need a custom, pen holder with Phil Rosen, best podcast host ever, written on it in their chat GPT, it'll get them a link to where to get that, which will be Etsy.
You sound like you've really done your homework on this, as I know you have. If someone wanted to replicate your strategy of picking these stocks that are out of favor, where would you start them?
I would say two things. I'm gonna give you the framework, and then I'm going to, I would say Seth Klarman once said something, and I didn't think anything of it for like my first 5 years in the business. He said, value investing, the longer I do it, the more I realize it's genetic. It's a temperament thing. And so I could tell you everything, and I will, and then there'll be like some small percentage like who genetically get it. So what I always tell people when they want to get into it, because we make it look easy and it's hard work, is read The Intelligent Investor by Ben Graham, which is Warren Buffett's favorite investing book. And either a light bulb's going to go off and it'll change your life and you'll never be the same, or it's not going to resonate with you. And if it's not going to resonate with you, don't try to push it just because you think, oh, this is how I can make a lot of money. It's never going to work for you because you're not genetically wired for that framework. There'll be other framework. You could start a company and invent the next, special device and make billions rather than, digging around buying PayPal at 80% off, right? So I think that's kind of the filter. Start with that book. Like, I'm serious about that. And then I'm talking to your audience. And then if you're like, wow, this is kind of amazing, I never thought about things like this, then, most people look at the 52-week high list. We like the 52-week low list. We start there. We find stocks that are out of favor. And then 90% of them are cheap for a reason, and you don't want to touch them. It's not just buying things that are down, because a lot are down because they should be down. And that's why like value underperforms of late, because people are just buying like low multiple stocks. It's like, well, they're low multiple because it's done, they're done. Or there's no catalyst for change. There's no jockey. They got the wrong person running it. So those are the three, solvency risk first, because if stock's down a lot, most people think it's going out of business. So you got to do balance sheet analysis. When does the debt mature? What is free cash flow to service that debt? What are the odds of them getting it refinanced? When and how easily? What are credit conditions, right? What are credit spreads? Then who's running it? The guy who set the fire, you can't have him do it. You need the new lady who's going to, add growth or whatever it's going to be. So jockey's critical, which is in line with catalyst for change. Does this person have a track record of turning things around? So we've got one called VF Corp, okay? They've been trading in and out of consumer brands since 1899. Okay. They've owned Lee over the years. They've owned every brand, Wrangler they owned at one time. So now they're down to North Face, which is hitting on all cylinders, growing 8%. Timberland, you see Chalamet with the Kardashian on the court with his Timberlands. Everyone wants Timberlands. And then you got this redheaded stepchild called Vans, which can't get out of its own way, but that's changing. And then you got Altra, which is the fastest growing running and trail shoe, but it's a tiny business. It's growing like 30, 40, 50% a year. So Bracken Darrell is the new CEO. He's been in about 1.5 years, 2 years. He's cleaning things up. He did the exact same playbook at a company called Logitech. Okay. Now Logitech doesn't cure cancer. They don't send people to Mars. What they do is they sell commoditized webcams and mice. Okay. They're not changing the world. He joined that company as CEO when the stock was down 86% in 2013. If you had put $1 million in when he became CEO to start the turnaround, 8 years later, you had $26 million in a beat down, boring business that had been around forever. He's running the same playbook at VF Corp. So what did he do? First thing is solvency risk. He came in, he sold off Supreme, took a loss, $1.5 billion, sold Dickies for $600 million, raised $2.1 billion of cash, paid down debt. They were levered 5-1. Now they're levered 3-1, which is a comfortable level, especially now they're cash flow positive. North Face was running on all cylinders. Timberland was running on all cylinders. They have JanSport and Eastpak. When you have kids, when you have kids, they're all going to be taking that to school, just like you did. And then pay down the debt, and then he cleaned up all the wholesale channels for Vans, because Vans is the one that's really been a disaster. It's been a weight on the stock. Vans is now bottoming. They're doing all these cool collabs with Versace, with the Satoshi Vans, where they were having riots on Fifth Avenue. People couldn't get enough of them. Now they got all these furry ones. I'm seeing guys at the country club wear them now. Like, it's crazy. Like, they're upscaling Vans because Bracken knows how to run it. I had him on my podcast and he was like, I'm not in this for a double. By the way, he bought a few $1 million of stock when he came in at like $13 out of his own pocket. And, stock's at 18. Stock will go back over $50, $60 over the next 3 to 5 years, because now all the bleeding is done. Growth is back. And all he has to do is focus on execution, which he has been. And you're going to just keep seeing the sequential numbers. And Vans is turning, which was the biggest part of the problem. So we like that. And that's a jockey situation with a catalyst. And he's doing everything he said he was going to do and more. So that's the type of stuff we like.
What's the ticker for this company?
VFC.
VFC. All right. So between VFC, Etsy, PayPal, if you could only buy one, which one?
Well, VFC's gone up a bunch. Etsy's gone up a bunch. PayPal hasn't. So I'd buy PayPal. Yeah. We got another one, which is really interesting. If you got time,
I'm all ears. Yeah, please.
So it's called Dentsply Sirona. So I call it my Sirona.
What's the ticker?
XRAY. Here's another one that's down 80%. And we bought a lot of stock over the last few months. As a matter of fact, your basis can be lower than mine. I think we're in the low 11s. It's at like 1050 today. Stock fell 80%. Why? It was another 2021 story. First off, they did a dumb deal. They bought Blythe. If you remember during COVID, like all these Invisalign teeth straighteners were selling at like $2,000 or whatever. They bought it at the peak. They overpaid by $1 billion. They had to write it down. That's the bad news. The dental supply and equipment business is a very steady GDP grower business, okay? Dental visits are still not at the level that they were pre-COVID. But if you think about demographics, aging, vanity, all that stuff, consumer confidence has been very low. As that comes back, kind of teeth is the last thing that you do. They are best positioned because as the largest equipment supplier and manufacturer, and they also do these CEREC machines. In the old days, you would go to the doctor, they take an x-ray, they'd say you need a tooth or an implant or a crown. We're going to send it to the dental lab, come back in 3 weeks for another appointment. We'll put it in. Now they can just image you, print the tooth, stick it in your mouth, and send you home. And they're the innovator in that category. So number one was solvency risk. So they do have a lot of debt. They've got $2 billion of debt. That's a concern. That's the bad news. The good news is none of it matures until 2030. They have a bladder business that's a cash machine that's kind of holding them over until the dental business inflects. They could sell that today, get more than $1 billion. The whole company is worth $2 billion. So that's like an optionality. 3, when we got in, we said, well, they're paying $125 million a year in dividends. They can and should cut the dividend at this stage because that'll open up $125 million of free cash flow. They did that. So solvency risk is all off the table. Then they brought in this guy called Dan Scavia. Dan was previously chief commercial officer, then chief executive officer of a public company called Globus, GLBS. During his tenure there, the stock was a 4-bagger. He's the guy that was brought in to do this. Most of the cost cuts are done. Most of the stabilization is done. They're a little bit behind on R&D. They're now investing that cash flow from the dividend in R&D to catch up. We think this can be a 4 or 5-bagger. Again, we don't know if it's going to happen in a year or 5 years. We have no control over the timing because that's the weighing machine. That's up to the weighing machine. What we do know is we're buying a good business that's been around for 125 years that serves a demand that can't be disintermediated by AI or by anything else because they have the mechanisms in place. Oh, and by the way, they renewed distribution agreements that the last idiot CEO had broken with Patterson, with Henry Schein, with all that. So they've got 5 new distribution agreements. The game is on, return to growth by the end of this year.
Man, I hope everyone listening to this is taking notes. This is a lot of alpha. Okay, Tom, so we got to wrap up here. I want to ask you, though, what do you think that you believe right now about markets, investing, stock picks that your smartest friends in the market would disagree with?
That's a good question. Well, it's very hard to stick to your discipline when the market goes through temporary periods of irrationality. And the ones who live to tell the story that you see 5 years later, that you see 10 years later, that you see 15 years later are the ones that never deviate from a proven system. And the ones that, you see are flash in the pan, they're here for a year, 2 years, they get a big following and all of a sudden their account's deactivated and then they disappear are the ones that can't help themselves. They have to chase the shiny object. They have to be in what's in the news every day and what everyone's chasing. And here's what I learned early on. Two things. Number one is compounding is the 8th wonder of the world. If you understand it, you can make a fortune. And the key to that, as Charlie Munger put best, is never unnecessarily interrupt compounding. And the way you interrupt compounding is you chase the shiny objects and they shut off the lights and it goes to 0 and you blow up. And so, yeah, we're not getting 100 baggers in SpaceX, but you get doubles, triples, a few 4 and 5 baggers along the way. You rinse and repeat in predictable businesses that have been around for some time that we can actually analyze the historic data and understand what the business does through different cycles. And you'll be pretty well off. The shiny object people, sooner or later, the casino always wins. Because what happens is if you catch a SpaceX or an Airbnb or an Amazon in 2000, and you make way more money than would be natural based on the underlying value of the business, meaning the short-term emotions rides you up, you say, I'm so smart because those guys missed it. They're worried about their spreadsheets. What do they know? Meanwhile, I just had a 3-bagger in a stock that trades at, 200 times sales, and I just rode the momentum. So what happens with those people is they believe their own bullshit. And they take all those winnings, and the next one that comes along, because they're so smart, they don't realize they were kind of lucky, they go all in on the next one. Maybe they hit it again. 3x, 5x, they ride the momentum because you're in a hot market. So I can't fail. Look at all these old schmucks that have been around for 30 years making 30%. I'm making 300% this year. Have fun being poor. They go in on the 4th one and they get a Cerberus, which was, perfect IPO at the perfect time when the ducks are quacking, feed them. We want semiconductors, give us more. We're going to help you out. Boom. You buy the top, they roll over, insiders get out, and they're going to keep getting out. And there you go. So unless you have a repeatable, defensible framework where your downside is covered and your upside is unlimited to some degree, sooner or later the casino wins.
You know, Tom, again, you make it sound so easy. This stuff is very difficult work, so I appreciate you sharing it all. Where can people find your work online?
Yeah, well, what we do for a living, as we like to say on the golf course, is God's work. We make rich people richer. We manage money. But that's greathillcapital.com. You can see if you qualify there. We have a podcast called Hedge Fund Tips with Tom Hayes, people that identify with this framework. It's a niche. Not everyone's going to like looking at balance sheets, cash flow statements, income statements. But the people who do have found it super helpful. Hedge Fund Tips with Tom Hayes, you can get it on YouTube, which is probably the best because we go through a lot of data and you can see it, but people listen to it wherever they get podcasts. And then our blog, we do an article about one or two of our positions every week at hedgefundtips.com.
Incredible. Thank you so much for your time. And anytime you're in New York, come back.
I'd love to. Thank you so much, Phil. And we're going to get you playing golf. And we're back. And by the way, you can find his podcast on YouTube, etc. I'm sure he mentioned it in the video. Then Diane King Hall, my buddy, on the floor of the New York Stock Exchange. Thanks to Diane and Caitlin Christ. We're going to listen in here. You're going to like this one.
We want to welcome in Tom Hayes, founder and managing member of Great Hill Capital, for a look across markets as we sit at and near records. The Dow's at a record, the small caps hit a record. In the S&P 500, we may not be at the record, but big tech at the top of the leaderboard. What does that tell you about what investors feel or how they feel about big tech and beyond?
Yeah, it's been the crowded trade. It's been the go-to trade since the war started. But I think we're going to go to the back to the future trade. If you remember, before the war, January and February, we had massive market breadth, a lot of participation under the surface. The unmagnificent 493 were doing exceptionally well. We are going back to that. Why? Inflation expectations have come down as a function of this deal. And if you recall, we talked consumer confidence is at multi-year lows. What's going to revive consumer confidence? Well, they have jobs, so what's the problem? The problem is gas prices were high. Well, gas prices have come down 54 cents since the top on May 20th. Inflation expectations are coming down. That's the highest correlation to consumer confidence. So I think the move is to start to focus on the consumer recovery and a rebuilding of confidence in the consumer over this summer and out of the crowded tech
So
trade.
this is the first time that I've heard the unmagnificent 493
Yeah, I coined it. It never really caught fire, but I continue to say it.
Maybe it will. And at the same time, the Magnificent 7 is not as magnificent anymore, especially when you have just, some bifurcation within that.
Yeah, it's people are calling it the lag 7. Here's the deal. They've run out of free cash flow. They're at, a capex to free cash flow is about 98%. They went from net buyers of their own stock to now net sellers of their stock. So they ran out of cash flow to finance the capex commitments. They've run out of debt financing, has kind of hit its cap, and now that some of them are having to issue equity. So you had Google, now you have Meta, you're going to have more, and that's not really a good scenario for the owners.
But do you think some of that is just to tap the liquidity that seems to exist right now? Because we have this kind of IPO fever that's happening. Yes, I know it's like SpaceX right now, but you've got a couple more mega IPOs coming this year. So I wonder if they're just going to market because they know the liquidity is here right now. So why not strike while the iron is hot?
Yeah, when the ducks are quacking, you feed them. However, if they could do debt financing, if they could do more debt financing, they would. Now, the fact that they have to move to equity and dilute their owners for the first time in many years tells you that the next phase of this, from cash flow financing to debt financing to now equity financing, is no financing, which means Q2 earnings, I think what you're going to see is a couple of these companies back off their commitments to CapEx. And that's when you're going to get some opportunity for bargains in the AI trade. It's not now. So now I think you shift gears and you say, everyone else is, when everyone else is zigging into tech and the AI trade, which is super crowded and super overbought, where's zagging? Zagging is the consumer's been left for dead. Consumer discretionary, consumer staples, and some of the defensive stocks are going to serve us well in the coming months.
So let me ask you this. What do you do with the AI winners?
I think you trim.
Okay.
I think you trim. I mean, I think we're in the fifth inning of this trade. I think it's going to go for many more years.
Fifth inning?
Fifth inning.
Because some say we're earlier than that.
Yeah, okay. Fourth, third, fifth, sixth, it doesn't matter. We're not at the end is the name of the game.
Okay.
What I'm sharing with you is I think there are going to be better opportunities to buy these crowded trades later in the year before the election. We've got Warsh coming up tomorrow. Historically, a new Fed chair gets tested in their first year. We may see some volatility over the summer. If that's the case, where do you want to be? You want to be in more defensive stocks? You want to be at lower valuation stocks? You want to be in those stocks that were starting to take off in January, February before the war, that have been left for dead, where you can find big opportunity.
Tell me a little bit more about consumer staples and what you like there. It's not a sexy sector, but
no, you can't give them away. By the way, the two lowest valuation sectors in the S&P right now on a price to sales basis are healthcare and staples. The last time they had this low of a relative valuation to tech was going back to 2021 tech peak and 2000 tech peak 26 years ago. That can persist for another year and staples can stay subdued, but I think on the relative valuation, many of these defensive stocks have dividend yield. What goes into favor when you have cuts? Demand for yield. And these stocks, your downside is protected and your upside could be meaningful if we run into some volatility.
And then let me ask you about this. Since it's healthcare's turn, you're not the first person I've heard say that this year or coming into this year. What backs that up? Yes, I've seen some momentum in healthcare and recovery, but there was also a head fake last year where we started to see some, and then now.
Yeah, look, I'm a long-term guy, turnaround Tom. We buy businesses when they're out of favor. It takes 3 years to get doubles and triples, rinse and repeat. So I can't tell you if it's going to rally in the next 2 months, but I can say over the next 2 years, value per dollar, you're going to get a great return with downside protected. That's why we like exposure in this sector. We love a company called Baxter, which is as boring as it gets. They do, get this, they don't fly to space. What they do is they do IV bags and infusion pumps in hospitals. They do hospital essentials. They do anesthetics. Stocks trading down to 9 times multiple, lowest multiple in 20 years. The new CEO, Alex Hitter, he spent 10 years at Danaher, the Danaher way. He had a 5-bagger at his last company, ASTS, which was a company that he ran. So he's applying the same principles. They sold the kidney business, which was a low-margin, slow-growing business, which weighed on the multiple. They delevered the balance sheet. The margins are starting to increase. They're coming back online from Hurricane Helene, which knocked out the IV business for a while. So we think this can, on a normalized basis, earn $3.50 a share. It's trading at a 9 times multiple. The normalized multiple is 18, which takes the stock up to $55, $60 over the next 2-3 years. And from here, that's almost a 3-bagger, 2.5 to 3-bagger.
And then we have less than a minute left, like 30 seconds. Your other idea is Hormel. This is a dividend story, right? This is a dividend story, and this is a food stock, but it's in line with the GLP trends because all of their brands are protein-centric. You got Planters Nuts, you've got Skippy, you've got Jennie-O, you've got Applegate, you've got Spam, okay? Everyone loves Spam. So you wouldn't believe how much they love Spam. So, I don't know about that, but go ahead.
65 consecutive years, not only have they paid a dividend, they have raised the dividend every single year for 65 years. You get a 5% dividend yield while you wait. Look, their margins were impacted by beef costs, okay? Their input costs are actually coming down. Margins are going up. They have cut costs in the business. Again, this is trading at a super low historic multiple. You be patient with this one. It's moved 20% off the bottom in recent weeks. It's going to continue to climb higher over the next couple of years, and we think this too can be a double with downside protection and a dividend while you wait. So, are we flying to the moon with these two stocks or to Mars? No. okay? But we're also not paying 100 times sales, and we have downside protection, and we get paid while we wait. So we love these stocks.
Thank you, Tom. Appreciate that. That is Tom Hayes. He's the founder and managing member over at Great Hill Capital.
And we're back. And then finally, Lance Glynn on the floor of the New York Stock Exchange. Thanks to Melissa Montanez and Lance for having me on. Let's listen in here.
Decision. Joining me now to talk all about that and more is Tom Hayes, chairman and managing member of Great Hill Capital. Tom, thanks so much for coming on with us this morning. Happy to have you.
Thanks for having me, Lance.
So we're already seeing a bump across markets on the news of the U.S. and Iran agreement. How much of a rally could we see today and in the days moving forward as a result?
Well, look, President Trump pulled a rabbit out of his hat. I think it's nuanced. So this is really good news. Inflation expectations are coming down. Oil prices are coming down. And the number one thing that's really hurt the consumer, with consumer confidence being at multi-year lows, has been high inflation expectations. So I think what you're going to see is the back to the future trade in the next 2 months. What does that mean? It means take yourself back to pre-war January and February, when you had massive broadening in the market, massive participation in the market. The unmagnificent 493 were doing exceptionally well. The only thing that's worked during the war period has been the AI trade. I think that trade you're going to start to see cool off a little bit. Okay, people are a little bit overexposed. You're going to see a little bit of profit taking there. Maybe not this morning, but in the coming days. And all these stocks that have been left for dead, related to the consumer, related to interest rates, are going to start to get bid and are going to start to go up.
So the back to the future trade, that means we got to bust out our Mandalorians? Is that what you're telling me?
I think that's exactly what you want to do. You want to get in the Lotus and rock and roll.
So how much was this news already priced in over the past several weeks? Because obviously we've heard and seen headlines pop up of it could happen, it won't happen, it could happen, it won't happen. As the U.S. and Iran were negotiating this deal, how much of a potential end to this was already priced in?
I think there's something to be said if you watch oil prices. It certainly wasn't in rates. That's going to be critically important. This sets the stage for Warsh on Wednesday to be a little bit more balanced. Like if he had come out without a deal and said, well, our inclination is to lower rates if the data supports it, it would look like he's a non-independent Fed chair. Now he's got the runway to say, hey, if the data supports it, we will hike. If the data supports it, we will cut. And then he'll do everything he can to start to cut. Why? Because we got to refinance a lot of debt. Housing is 18% of GDP. The home builders have been left for dead. People want affordability in housing. So I think this all points to positive things. Right now, expectations of a hike were as high as 77% 2 weeks ago. They're down to 50%. I think in coming couple of months, you're going to see the odds of a cut go up, and that's going to be really, really good for the economy. But don't chase what's worked. Even though you see the NASDAQ up big this morning, start to buy those things that were working in January and February when you had the everything trade, the Main Street trade, and you're also seeing it in small caps actually up quite a bit this morning.
And so oil prices clearly fell, obviously, on the news. What other economic markers are worth watching, or are you watching now that this deal is in place and will be signed on Friday, or likely will be signed on Friday?
Yeah, I think positioning is something to keep an eye on. You have the highest equity positioning since the peak in 2021, so it's something to be a little bit cautious. On the bullish side, you've got 24% earnings growth, which is good. You got GDP now at 3.3%. You got gas prices down 54 cents since the May 20th high. So there's a lot of positive stuff, but I think you've got to be nuanced, and you got to let the dust settle for the next couple of days. You got SpaceX up this morning. You've got a lot of excitement. You got a lot of froth in the market. But the other thing to pay attention to is if you look at the two cheapest sectors in the S&P 500 on a price to sales ratio, healthcare and staples, they've been left for dead. They're at the greatest relative value to tech going back 26 years. So everyone wants tech, no one wants healthcare and staples. Same thing they wanted in 2000 when Buffett was buying Coca-Cola, Procter & Gamble, and when everyone else, got a little sideways on tech in the subsequent few quarters, he made a lot of money on those type of stocks.
Now, one of the things that you point out in your market analysis is that people should not get too bearish as the highest equity, as we see the highest equity allocation since the tech peak in 2021 you just mentioned. What leads you to think that? Like, what leads you to believe that we shouldn't be too bearish about it?
Well, I think there are a lot of strong underpinnings. I think rates coming down is going to be very positive. And I think you could see a situation where indices performance is subdued in coming weeks. I know that's hard to say on a morning like this, but maybe starts to stutter a little bit just because 40% of that's related to the AI trade. But if you're buying those things that haven't worked in the last 2 to 3 months during the war, you're going to find that those start to rally. So you may not see it in indices, the stocks that are going to do well, but under the surface, there are going to be a lot of stocks that start to do well with rates coming down and inflation expectations coming down, particularly related to the consumer.
Now, you mentioned Kevin Warsh a few minutes ago, and obviously his first meeting as Fed chair is going to happen on Wednesday. His first decision as Fed chair, I should say, is going to happen on Wednesday. What to you is more important? Is it what ends up happening with this decision, what happens with rates, or what he says after the fact, and the words that he ultimately puts out to the general public?
I think it's going to be the press conference all the way. He's not going to do anything this week. Everyone kind of knows that. It's going to be his forward guidance. Number one, the market doesn't want to see that he looks independent. So he doesn't want to be like, hey, I'm going to cut the hell out of, we're going down to zero.
Cutting, absolutely.
He wants to appear balanced. He wants to be data dependent. But at the same token, he's going to move things in the right direction. Now, that said, we also have to be cognizant. We're very excited today. The market has a tendency to test new Fed chairs. Historically, you get a 15% correction. I don't think we're going to get any of that because earnings growth is too strong, GDP is too strong, people have jobs, employment is too strong. However, it wouldn't be shocking in coming months to see a little summer volatility, a little pre-election volatility, and that's where you're going to benefit by hiding out in some of these more defensive stocks that are on sale, that are cheap, that are also, in many cases, dividend payers. And when rates come down, the demand for yield goes up. So anything related to yield, whether it's REITs, whether it's staples, whether it's healthcare that has dividends, I think you're going to start to see those do well in the next 60 to 90 days.
So, Tom, we're approaching the midpoint of the year. Are there any headwinds on the horizon that concern you moving forward? Because it's been a lot of positive talk. Is there anything you're really looking out for that could bring that summer volatility you just mentioned?
I think the most important thing that we've been focused on and talking about for a while is CapEx of the hyperscalers. Now they've kind of drained free cash flow. They're close to 98% of free cash flow in CapEx. So what's happened? They've had to issue a lot of debt. Well, now they've run out of what their capacity to do in debt markets, although NVIDIA is now raising $20 billion in debt markets today, we saw. Then you see Google raising $80 billion, $85 billion, diluting their shareholders. You're seeing Meta now looking to do an equity offering. So I think that's step two. I think step three is going to be when shareholders start revolting on equity dilution, which they won't right now because everyone's excited. But when they're not seeing the return on invested capital as quickly as they want to, they're going to revolt. And I think in Q2 earnings season, after July and August, you're going to start to see a couple of these companies scale back on their CapEx commitments, and that's when people are going to get worried about the AI trade. Long term, if you've got a long-term view, I think we're mid-innings, fifth inning. But I do think there could be a pretty abrupt pause prior to the election in that crowded trade, and that should be the catalyst. So just watch equity issuance, debt issuance, free cash flow. They've gone from net buyers of shares to net sellers of shares for the first time in many, many years. And that's AI related, 40% of the index, so that could put some weight on the indices as those cool off.
Tom Hayes, Chairman and Managing Member of Great Hill Capital. Tom, thanks so much for joining us as always.
Thanks for having me, Lance.
Now coming up, we'll take you to...
And we're back. Then I want to thank the folks over at Bloomberg, Ruth Carson, Winnie Hugh, and Abhishek Vishnoi for including me in their article on Bloomberg this week. And finally, thanks to the folks over at Reuters for including me in their article this week. Our quote of the week is, most people get interested in stocks when everyone else is. The time to get interested in a stock is when no one else is. You can't buy what is popular and do well. Unfortunately, I know Warren Buffett's quotes and framework a little bit better than Greg Abel, because Greg Abel basically put $10 billion into Google at a short-term top. So sad to see, but I did like their Taylor Morrison deal, buying home builders when they're out of favor. So there is still Warren's fingerprints on one of the greatest conglomerates ever built, but there will never be another Warren in the way that Warren was so great, and certainly not Greg. Greg is a sensational business operator, but capital allocation is a completely different skill set. So they'll get the value. It'll just take a couple years. You'll see how that plays out. So let's move along. Want to thank Zek Hong for doing the most incredible surprise video. Zek has been with us. He came from Statman, who teaches statistics at Westminster High School, and I've been over there to talk to his students. I'll probably be going in the fall as well. And he's given me incredible tutors for my kids from his incredibly smart students. And Zek has done an incredible job on the marketing side. All those incredible videos you see all over social, he does. And he decided on his own volition to create this extra special video. This is going to bring a lot of great memories back for many of you. Go to hedgefundtips.com, click on #1 Hedge Fund Podcast, play that. He really did a special job. So thank you for that. It's not my birthday till next month, but that's probably the best birthday gift I'll get. And I really appreciate that. Then I want to thank the folks sending in their incredible pictures. Joe Cook, looks like he works at NBC or CNBC with his Hedge Fund Tips mug. You're looking good, Joe. Thanks for sharing. That's awesome. And then Patty Knappman. These British, they love me over, prophet's never a prophet in his own land. They love me over in England. And boy, oh boy, they're going to oh gosh, I don't even have it on me. Anyway, whatever they do in England when they get all dressed up with top hats, and half of them wore the Hedge Fund Tips hat. Can't thank you guys enough. Patty, it was so great meeting you when I was over there, and crew, we love you over in the UK. You guys rock. And then we saw Jim and Mark and all these amazing folks that have been sending in the photos. Look, since Jennifer, who's my amazing assistant, put together all these new items with the logos, the t-shirts that have "Burning Yourself with the Facts" on the back, all the famous quotes that you guys not just learn and say, but actually practice and make money with, the hats, the mugs, and then you got to click, there's too many options now, you got to click view all to get to the old stuff. Look, the reason we have this is we do this every week. We put our heart and soul into it. We've done it for 7 years now. You guys have made me want to continue doing this, not only for clients and non-clients alike, because you're out there every week sharing it. We ask you, with one person you care about, that this would make a difference for, and you're doing it. We're growing every single week because of you, and as a result, we continue to deliver. We leave it all on the field every single week and deliver as much value as humanly possible. And one way that people find it easy to share, rather than send emails like, "Oh, you should listen to my friend's podcast," is they wear the shirts, they wear the hats, they have the mugs in the office, and people say, "What's that?" And they say, "Oh, I listen to this podcast. Do you like investing? You got to listen to this guy. He's great, blah, blah, blah." And that's how it grows, word of mouth. So you guys keep sharing, whether it's wearing a shirt and people ask you, or wearing a mug. And I'd only ask this: when you get this stuff, we're grateful, but we make nothing on it, okay? It goes to Foursquare or Fourface or whatever the hell the middleman is. It's send in a photo of you're wearing it so everyone can see everyone in the community together. We get probably 10 times the amount of orders that we get pictures. And I know some of you are shy. And if 10 years from now, you say, "Tom, I don't want to be on your website anymore, because of XYZ, we'll take you down. It's not a big deal." So anyway, thank you for that. Keep sharing. Very grateful. Let's get down to business. Token price index for the AI trade. Price is falling. Why is price falling? Why did Microsoft cut that deal with, cut that spend with Oracle on the basis of quote unquote security, which I discussed with Phil? Oracle doesn't have security problems. Microsoft has CapEx commitment problems is what it's going to come down to. And we're going to find out about that in Q2 earnings. People have been worried about Alibaba. Why is Alibaba down? Because Trump administration put it on the military watch list. At the end of the day, they put a bunch of them on. It's a negotiation. Xi Jinping will be over in September. They will have a handshake. They'll get nothing done again. Or maybe they will this time. They didn't get anything done in the last trip. But this is par for the course. At the end of the day, and we'll go through a couple things today, go back to the article we did after they did earnings and burden yourself with the facts about the fundamentals of the business, which are doing fine. But this is normal after a big move off the bottom. People finally got in up here, all excited at 190. And guess what? Just like in 2018 and 19, it pulled all the way back to the one in teens, below 120, before going and making the move to 301. So from 56 to 200, everyone jumped in at 200, all excited on the quote unquote breakout for all the traders out there. And then went from 200 down to 123. Same exact story here. 54 all the way up to 190. Take out all the weak hands all the way down to below 110 before our next big leg higher. And that's the name of the game. Still the cheapest AI play in the world. No problems there. We're adding at the margins. We're not adding a ton because our basis is much lower, but we're adding at the margins, putting some new money in it as well. And that's that. And it's not to diminish them getting on the list. I'd rather they're not on the list, and maybe we'll switch the BABA shares we have to the 9988 again in Hong Kong. But I think it's more posturing. That's been the modus operandi. Look, Trump made it clear this week. He says, I don't want to be Herbert Hoover. If he blows up the commercial relationship with China, he becomes Herbert Hoover, and he will be remembered as the worst economic president in the history of mankind, like Herbert Hoover was. He is doing everything in humankind to avoid that, as you saw with the MOU this week. And the last thing he wants to do, which is why he got on a plane and went all the way to China with 30 CEOs and got nothing, because he wants to keep the dialogue open and he doesn't want to blow that up and become Herbert Hoover. What he does want to do is become Ronald Reagan, who had a booming economy in the 80s, so he can go out on the top like Seinfeld and with a booming economy. And blowing up China or delisting China shares is not going to help him. It's only going to hurt him. So our bet is that cooler heads will prevail. The underlying business in the short term, it's a voting machine based on price and emotions and headlines. In the long term, it's a weighing machine, still the highest quality AI player at a reasonable price globally that's going to own the Asian AI business hands down. S&P performance under new Fed leadership since 1930, mixed results. On balance, they get tested in the first 6-9 months, and I think this time will be no different, and it'll be mostly concentrated in the AI cool-off we shall see. Retail investors' cash allocation is at the lowest level since the 2000 highs and the 98 highs before they had a pullback before the next run, similar to right before COVID in 2018, 2020, 2021 before the cool off. So we're at those cash levels again. A lot of the excess is in one narrow silo of the market. That will be the part that gets hit. I think the rest of the market is going to do quite well. 2027 AI hyperscaler CapEx scenarios. I think these are going to change pretty quickly. Micron, we talked about on the TV stuff. Semiconductor rolling 14-month returns, the exact same level they were at the 2000 peak. So beware. Things overshoot on the upside, they overshoot on the downside. Micron, we spent enough of that on TV. Tech sector, same thing. You got to go back to 2000 to find these extremes. Tech weighting, same, back to 2000. So it doesn't repeat, but it rhymes. Dividend yield, you can't give it away. No one wanted to buy them in 2000. Everyone wanted them for the subsequent year. Same story here. You want to be getting some exposure to dividends. Rates will come down over time. Apple price to sales ratio at levels not seen since 2007. Louisiana purchase spending as a percentage of GDP. The only other, so we're spending more as a percentage GDP on the hyperscalers on AI, 2.1% GDP than the U.S. railroads before they blew up in the 1850s. Something to keep in mind. The only time that we exceeded that was the Louisiana purchase, which is not really a good comp. FMS investors say AI stocks are in boom stage, so everyone's all in on the boat. Sentiment cash levels came a little bit, they built up a little bit of cash in June volatility. Eurozone stocks, everyone's out. There's probably some more bargains there over the summer. Most least underweight the dollar, so they are been dollar buyers. I think that's a short-term, that's an intermediate to long-term mistake. Global sentiment, everyone wants banks. No one wants discretionary and staples. No one wants anything related to the consumer. This is the time to buy things related for consumer because consumer confidence is going to come off the mat. Gas prices down 50-something cents in the last 2 weeks and going a lot lower. Most crowded trade, and this is like more crowded than a lot of things, than even Mag 7 was, is long global semiconductors. Get ready for a brutal unwind at some point in that group. Certainly you want to be lightening up, and there'll be better chances to buy them later in the year in our humble opinion. S&P 500 PE holds at 20 times. So it's, again, a little elevated. Equal weight, a lot more reasonable. Realized and consensus EPS growth forecast. This year, 24% for the S&P, 17% next year. That's the bull case. The last time you saw estimates that high, though, was 2021, right before tech pulled back. So just keep that in mind. Record 12.3 inflows into tech. So there you go. Opinion follows trend. Bad breath usually mean reverts, which means non-tech is going to start to outperform just as it did from 2000 to 2003 in a way that we've never seen before prior to that. That's puts volumes now on volatility. SpaceX valuation, it's not even worth my breath at this moment. Momentum crowding score. Yeah, highest momentum crowding score in the 98th percentile. Probably got to go back 26 years to see people crowding into a few single stocks before they blow up. And it's all retail. You can see it's retail flow. Here is the speculative short ETF volume. It's kind of moved up. You usually start to see these moves up before you get a little bit more pullback. Private sector jobs growth picking up. MSCI Emerging Markets Index versus S&P 500, dramatic outperformance. Even over 25 years, despite the last 10 years going flat, still outperformed the S&P 500. So emerging markets continues to be interesting. That's been a core theme. Stocks turbulent following Fed chair changes. You can see here the average is 12% in the first 3 months of a new Fed chair without fail. Employment in the top 15 AI exposed sectors has continued to struggle. Business formations are up. Geopolitical events. Midterm years versus non-midterm years. This is average S&P performance. So in midterm years, June tends to be weak. We'll see what happens the last 10 days of the month. And when we say indices weak, that's going to mean the AI trade. It probably means defensives get bid. August week, September week. So I think these are your risk areas, actually. We didn't have that weakness in May. That would be historically correct. So it could be that it would be different this time. But June, August, and September tend to be weak midterm election years. And if the indices are weak, it's because the AI, which is 40% of the index weight trade, is weak. And that's our base case. Hyperscalers float shares. So they've been net buyers of shares since 2018. Now they're net sellers. Free cash flow as a percentage of net income is at its lowest level in many years. It went from 90% down to 70%. This is what I'm talking about with the Fugazi earnings from the hyperscalers, all paper gains on quote unquote other income from their holdings in Anthropic, SpaceX, OpenAI, etc. They are paper gains. U.S. median listing price changed from a year ago, down 2%. Housing is weakening as we anticipated, except in certain parts of California, which I'm sure will get hit. They're always the last one. Hyperscaler leverage is 0.9 times higher versus when we started tracking in Q3 2025. Net and gross leverage. That's interesting. The ratings may start to come down, which may force them to do more equity, which may force owners to get pissed about getting diluted, which may cause them to cut back on their commitments. And I think you're going to see that in Q2 earnings. Next, we have Citi Economic Surprise Gauge, tends to follow U.S. Economic Pressure Index. So the pressure index is in black. It's been rolling over. The surprise index has been strong. So one of these two things has to catch up. We're going to find out which one. And I didn't like seeing the yield curve flattening, which I discussed on the Big Money Show. Which I got to post there. And let's see, S&P seasonality, June again, there should be some weakness. And then again in August and September, according to data going back to 1949. The weakest 3 months are February, which I think we started to see the war at the end of February. Then second half of June, then first half of August, and then second half of September. Retail single stock demand weakest since COVID. That's interesting. Market cap weightings, traditional cyclicals, defensive demand is lowest since 2000. Tech is highest. You can see the fish mouth. These divergences always narrow, similar to what you saw in, oh, this is interesting. So you had the fish mouth in 79 when everyone wanted cyclicals versus defensives. Then in 89, it looks like 91, everyone wanted defensives over tech. Then by 2000, everyone wanted tech relative to defenses. See, these mouths always close. These divergences always close. This is what we do, guys. We buy divergences in price relative to fundamentals and play the mean reversion. We play divergences in sectors relative value. When they get to extremes, we look for opportunities in those areas that are out of favor, like Buffett's quote from today, which was, most people get interested in stocks when everyone else is interested in them. The time to get interested in them and or those sectors, by the way, is when no one else is. You can't buy what's popular and do well over the long haul. And now you've got, everyone wants tech, most stretched that it's been, well beyond 2000, and no one wants defensives. This will snap back like a rubber band. U.S. emergency oil reserve, lowest since 1983. They'll fill that sucker back up when oil gets down a little bit more, so you don't have to worry about a glut. Return on equity, mega cap tech going down, rest of S&P going up. Where do you think money's going to start to flow? Equity supply poised to surge. The ducks are quacking. They're going to feed them like they've never fed them before. That's going to create a lot of supply and put demand pressures on those high-flying, shiny object stocks. Materials positioning at an extreme low. Maybe we should go back and look at some of those. We had that Albemarle play the last time it was at this relative extreme low. Let's see what we can find in materials. By the way, this is going to be a long podcast this week. Next week's going to be super short, so soak it all in. U.S. levered inverse ETF exposure, highest ever. A lot of gambling, like Buffett was talking about. There seems to be a lot of demand for gambling right now. That's not a time to be chasing what all the gamblers are chasing. Retail sales look good. They're going to get better. Consumer confidence is going to go up. Left for dead consumer stocks and consumer discretionary and staples are going to do well. Big tech's disappearing buybacks. Home contract signings rise again in May as housing becomes more affordable. June swoon historically starts today and goes through the end of the month. Household cash as a percent of total financial assets. By the way, that should be good for defensives. Net ETF net inflows, strongest year in history. Market expectations for Fed funds rate. We talked about that on TV. Retail cash, May and June trading is record breaking. May and June trading. Okay. Hyperscaler, free cash flow versus CapEx. Wow. Is that wow? Free cash flow is going negative 25, 26, 27, and CapEx is going to be close to $1 trillion. That math don't math, ladies and gentlemen. You'll see what's going to happen. They're going to blink like Zuckerberg did with the metaverse. Commodity price index weakening. Stock price index, consumer confidence. Expecting higher prices in 12 months. That hit a peak. That's going to come down. And there we go. All right, some headlines. A place where some AI stocks are still cheap, which is China. This is an article this week from the Wall Street Journal. We agree. Alibaba unveils AI models for robots amid shift from chatbots to agents. They're ahead of the curve. Jack Ma-backed Ant Group set for high-stakes overhaul of billion-user app, biggest PayPal of Asia, basically. And we own a third through Baba. China moves to end irrational food delivery subsidies and the sector's price wars. That's good. That means margins will go back up. Alibaba bids $1.5 billion for China grocer in Meituan fight. China watchdog urges more IPOs from AI, Hong Kong listed firms. This one, I think that was just job cuts at their cleaning house at Diageo. Why Guinness beer keeps growing while beer sales worldwide fizz out, because we're the best at Diageo. Next, great American housing shortage is finally forcing a search for solutions. Granny flats in California and single staircase codes in Texas. States are trying to fill a gap that has pushed home ownership out of reach for many. So they're coming up with all types of solutions. House and Senate leaders reach deal on housing bills. So that's another thing. Boost affordability, etc. Next, U.S. pending home sales see biggest gain since September 2024. Kelley Blue Book report, new vehicle price increases moderate in May. Incentive spending grows. Incentives are the name of the game for U.S. auto sell-through, which helps Cooper Standard get to $10 in earnings when we hit 17 to 18 million sell-through, which we will, as we have every peak for the last 45 years, despite the population being much smaller than a third smaller than it is today. Latest credit card data is good news for consumer stocks. Retail therapy is alive and well. Again, shift to the consumer sector's discretionary staples. Iran deal could expand market gains with consumer shares, small caps even benefiting. I think, was I in this one or a different one? Anyway. Next, Goldman traders see room for rally to broaden beyond AI winners. I don't know if I was in that one. Trump-Iran deal kicks in as focus shifts to Hormuz flows. They started flowing in the last 2 days. Big tankers, 2 million barrels each. Retail investors have been buying more SpaceX shares than all the Magnificent Seven combined. Tells you everything you need to know what's coming to a theater near you. Grab the popcorn and wait. You're going to be able to buy it at half off. And when it becomes half off, no one's going to want to buy it, and that's going to be the time to buy it. Turbocharged earnings are pushing stocks higher. There's a catch. Big spending, but the bill comes later. Many of the subjects we've covered before. Scared of big tech's AI spending? Just wait till 2027. Market's going to start to sniff that out in Q2 earnings. PayPal winds down venture arm. That was a waste of money. Good for Enrique Lores. Dentsply Sirona appoints John Forston as chief financial officer. Solid pick. Comstock announces $600 million strategic investment by 6th Street in Pinnacle Gas Services. We love this as a covert AI play. Natural gas out of favor right now. Unlimited demand moving forward. Warsh, best asset, best location. Warsh overhauls how the Fed talks and keeps markets guessing on rates. It's exactly what we want from a Fed chair, confusing us on a regular basis. High protein, high spirit stock market and sentiment results. This is our article of the week, and here we go. Top 5 key points in the Bank of America Fund Manager Survey. We talked about the boom phase. We talked about the most crowded trade being semiconductors, global growth expectations turning back up. No one wants European stocks, so European and materials we got to start to check out. Diageo. For newer readers, here's the overview. Go to hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Consult your financial advisor or psychic before doing anything. And if you don't have one, we might be able to be helpful. After booking the initial kitchen sink quarter, where new CEO Dave Lewis cut the dividend and aired every shortfall under the prior management to reset expectations. It took just one quarter for the first green shoots to emerge. Diageo's Q3 fiscal year 26 results snapped a 2-quarter run of weak economic growth. Q2 was negative 5.2, Q1 flat, with organic net sales rising 30 basis points, well ahead of the negative 2.3% decline feared by consensus. Strength was broad-based across the portfolio, with 3 of 5 regions delivering at least high single-digit organic growth. Europe led the charge at 8.8%, accelerating from 2.2% last quarter, driven largely by continued double-digit growth in Guinness across Great Britain and Ireland. At a time when most beer players are struggling to find a pulse, Guinness remains a bright spot in the fastest-growing major beer brand in the world. Management expects that momentum to continue into the back half and beyond as new capacity comes online across both its largest markets and those where penetration remains relatively low. Beyond Europe, Latin America, and the Caribbean grew at 16.2% on broad-based strength and some early FIFA World Cup buy-in, while Africa posted 17.1% growth, driven by double-digit gains across both East Africa and Southwest and Central Africa. APAC declined a modest 80 basis points, or less than 1%, with the weakness largely outside of Diageo's control. A shift in Chinese government policy drove greater than 20% decline in Chinese white spirits, masking what was otherwise a healthy quarter that saw low single-digit growth in international premium spirits. As those policy headwinds are lapped over the coming quarters, the underlying strength of the APAC story should begin to reemerge. That leaves North America as the final pain point left to address. At 38% of net sales and more than 50% of operating profit, this remains the engine of business and the heart of the Diageo turnaround story. On that front, there is still plenty of work to be done, with North America organic sales declining 9.4% as the U.S. spirits portfolio fell 15.4%, driven by another quarter of double-digit declines in tequila. Anyway, I'm not going to repeat that Kenny Chesney song. Unlike prior management, Lewis isn't the type to sit on his hands, make excuses, and wait for the macro to bail him out. Under his leadership, Diageo is back on offense, focusing on the levers within its control rather than simply riding out the cycle in its largest market. The plan to fix North America is already underway across 3 fronts. First is an executive overhaul that has installed John O'Keefe, one of Diageo's most experienced spirits executives, as North American CEO, alongside the planned departure of North American CMO and additional changes across the senior leadership team. Second, selective price repositioning across the portfolio to better target the mass market, an area that had been largely neglected under prior management. In many cases, Diageo's own brands within its 200 brand plus portfolio were effectively competing with one another at the premium end of the market. The first example of this repositioning is already playing out with Casamigos in Florida and other key World Cup host cities, where early results have reportedly been highly encouraging. These are still early innings of the same playbook Lewis ran at Tesco. Narrow price gaps, recapture share, and allow volume growth to more than offset modest margin pressure. Third, and perhaps the most strategically important, is a long overdue push into the ready-to-drink cocktail market. Canned cocktails are one of the few categories driving growth in the U.S. market today, and Diageo has largely been sitting on the sidelines. This was an area effectively abandoned after prior management's pursuit of premiumization at all costs, largely due to concerns around margin dilution, yet RTDs have been the standout performer through the broader alcohol downturn, growing at 13% CAGR since 2016 versus beer at negative 2%, spirits at positive 1%, and total beverage alcohol at negative 1%. We expect that change under Lewis, with a formal RTD strategy likely to be unveiled at the upcoming Capital Markets Day. So you can go through the key things. Diageo will serve as the official spirits supporter in the Americas, making the first time a spirits producer has ever sponsored the tournament. That's FIFA, with 104 matches played over 6 weeks, plus 64 in prior tournaments. This will be the largest World Cup in history. And with more games comes more alcohol. Industry estimates suggest the expanded format could drive more than 1 billion incremental pints of beer consumed over the course of the tournament. Guinness, as the world's fastest growing major beer brand, should capture more than its share of that demand, while activations across Casamigos, Don Julio, Buchanan's, Johnny Walker, and Smirnoff at stadiums and fans festivals will place these brands directly in front of consumers at scale. If executed properly, this is the type of catalyst that can drive momentum well beyond the tournament and the current quarter. Looking beyond the World Cup, the long-awaited Capital Markets Day is scheduled for August 6th, when Lewis is expected to unveil the company's full strategic roadmap and redesigned operating framework alongside fiscal year 26 results. After several years of strategic drift and underwhelming execution, this is the reset investors have been waiting for. Just 2 quarters into his tenure, Lewis is already providing the first tangible evidence that our cyclical, not structural call is beginning to play out. At the end of the day, this remains the highest quality name in global spirits, supported by a portfolio of iconic brands, industry-leading margins, and now a proven turnaround operator at the helm. While the voting machine remains focused on near-term noise, we're more than content to let the weighing machine catch up to the earnings power this business is capable of generating on the other side of the current downturn. Like we always say, we like to buy the highest quality assets in the most dislocated sectors. Diageo is no different. 10 key points you can go through at hedgefundtips.com on your own. Earnings call highlights, the key things you want to focus on are underlined for you, along with the analyst note. Hormel update. For newer readers, here's a brief overview of the thesis, and now to the updates. 10 key points. Hormel delivered its 6th consecutive quarter of organic net sales growth at plus 3% year on year. EPS was up 14% year on year. Gross profit up 7% year on year. Adjusted operating income up 11% year on year. Retail was flat. It's the service business that's been growing like a weed. Food service was up 6%. That's 34% of total net sales. International segment up 4%. Operating cash flow, $179 million this quarter. Hormel returned $161 million. 391st consecutive quarterly dividend payment, maintaining its dividend aristocrat status, supported by more than 60 consecutive years of dividend increases. Locking that in around 5% right now is an opportunity that comes once in a generation, and it will grow. Management reiterated full year fiscal year 2026 guidance. When I say generation, I'm talking like 25 years of 12 to, they reiterated guidance. And finally, let's talk about sentiment for the market. It's probably neutral to fearful. Active investment managers taking a little risk off. So we'll see that. Retail REIT earnings, top 30 weights in the sector. Estimate revisions in the last 60 days up 2.36% for this year, up 2.42% for next year. Utilities earnings estimates and revisions up 25 basis points for this year, up 1 basis point for next year. Dentsply Sirona had $500,000 of insider purchases from Michael Barber, director, Brian McKeenan, director, Brian Gladden, director, Betsy Holden, director, Clyde Hossain, director, collectively purchased 51,746 shares of Dentsply Sirona. My Sirona, which I talked about on Varney & Co. Retail sales were good this week. That's the number one thing. FactSet earnings growth expected to be 21% this quarter. We shall see. And now on to a fun part every week is Ask Me Anything questions from our audience. So let's turn these on. Our first question comes from let's see. Robert Wart. Hey, Tom, I know you don't like software stocks, but can you still look at SAP? I think you answer your own question when you ask the question that way, but let's take a look. Yeah, I mean, actually, SAP is a little different. I've been looking at SAP. This can't be easily disintermediated. Yeah. I'd like to see it in the 120 to 140 range because it's just going to... The issue is it's cheap relative to the underlying fundamentals, but it's going to overshoot on the downside because it hurt a lot of people. What is it down? It's down 50%. When it gets down 80%, turnaround Tom gets interested. When it's down 60%, meh, on to the next. So thanks for sending that out. Next, Zivco, Adobe. No. I look at it every week too. Again, I take a picture, I put it into Grok, it does whatever I want. So am I going to need their stuff anymore? I have no idea. Like it's a complex business. They have more than that, but I don't think it has this. It certainly doesn't have the moat that SAP has. I mean, you look at the financials though, they're just generating cash hand over fist. They're buying in shares cash hand over fist. But again, I think these things are going to overshoot more. So, I mean, I would get interested around $100. I don't think I'm going to get it, but send it back. It does look cheap here, but I'm not going to get involved because it overshoots and I have no way of discerning the moat. Tim Trushell. Tim is asking about GXO, NOV, and X-ray for the rest for 2026. I have no idea. We think in terms of 3 to 5 years. NOV's had a big run. It's probably going to take a breather with oil coming down, but we're going to be in it for another few years, my guess, until it gets to our target. GXO hasn't even started yet. X-ray hasn't even begun. So these are 3 to 5 year plays. If you're looking for 6-month plays, wrong podcast. Simon Stazunius, thank you for all the great. And by the way, thanks for sending in the question. I've watched every podcast since December 24. Okay, so this guy's crushing it. Some stocks that have met the frameworks, and he's making money. So good job there. That wasn't a question, but congratulations. Nick Gale. Yeah, we covered the Baba question. Zoom out. Same story, different day. Gunjan SYM. Let's see, Gunjan. Symbotic. SYM. Huh. What do these guys do? They're issuing a lot of shares, by the way. They've tripled the share count, so I don't like that culture of robbing from your partners, from your fellow owners. I just hate that culture. I mean, there has to be some of that in VC type stuff, but automated technology company develops and enhances operating efficiencies in modern warehouses, automates the process of pellets cases and individual items. Yeah, the automation business. I understand what you're talking about. This is not for me. This goes in my too hard box. It might work. I understand why you're interested in it, but there's just no way for me to have an edge there. Simon's okay, yeah. Congratulations, Simon. Alejandro, MGPI ingredients. I think yes. IFF. I've been looking at, I think I missed IFF and Darling. Those are two great businesses. MGPI, I think we might have done this one also, but I kind of like all of those ingredients businesses, like International Flowers and Fragrances, Darling, and MG. Well, yeah, this, you just have to get some comfort around. Like, this is, I mean, they had a situation like this in 2010, but this is really bad. Like, what is going on that the revenues are falling this much and they're increasing the share count? So MGPI, I'm a little bit concerned with. It looks like they did a deal that didn't work. Revenues went up for a minute and then fell apart. So how is this going to turn back up? How are revenues going to turn back up? Let's take a look on quarterly if there's any light at the end of the tunnel that's not an oncoming train. The answer is no. So you got to see some inflection in revenues and get on the calls and understand why it's fallen so much. Let's see if Darling's has fallen commensurate, because I know when the chemical stocks were down, they were all down. Darling's fell, but it looks like they're recovering, and the stock has recovered. No accident. And International Flowers and Fragrances, let's see that one. Yeah, that one's starting to recover. And let's see what's happening with their revenues. I'm not saying no to MGPI. I'm just saying go do the work and find out what's the plan to inflect. Yeah, this one's been flattish. So the whole group has that feel to it. Might be worth some further work. Find out what mistake they made on that deal. Millennials, blah, blah, blah. You think about this in your framework. Healthcare seems like an obvious one. Yeah, he's asking about demographics. We cover that like every 3 weeks, Kyle. So, yeah, I agree with your healthcare. We also cover that every 3 weeks. So welcome to the podcast. Thanks for sending in the question. Hyperscalers recent issue find more semiconductor. Change your thinking about semiconductor stocks over the coming months? No. They're good. When they turn, it's just going to be like overnight. And people are going to, what happened? And then the interesting thing is when you're gambling in the casino and you're not detached to fundamentals, the beauty is you start to think that you're super smart versus lucky and that you saw something that other people didn't. So what happens is after they go parabolic, you're anchored to pleasure to that position and you ride it. And when it has its first 20% pullback, I'm telling you, this is what people do. After it's up 5x and it's gone parabolic, rather than getting the hell out because they stayed too long at the party, after the cops were coming, they buy the 20% pullback because there's an emotional behavioral anchor that causes them to do that. And then it goes down another 20% and they buy that and then they're roasted because they don't realize that they were the bag holders. And that's exactly what's happening right now. It's transferring from the strong hands to the weak hands and you'll see. So, and it can be irrational for longer, but you don't buy stuff up here. Ben Aaron. Yeah, Ben, that's just a function of experience. He's saying like, oh, if the stock's gone up a lot and the fundamentals are good, blah, blah, blah. Because there's always, you have to use the short-term voting machine based on price to your advantage. So when it's gone up a lot, even if the fundamentals are improved, the question you got to figure out is how much is priced in and how much isn't. And am I going to be a pig and try to get the last crumb of the crust, or am I going to take the sweetness out of the middle and leave the crust for everyone else? And the answer is, if you want a long-term durable career where you compound money and don't get killed, is you take the sweet part out of the middle and you leave the crust for everyone else. And that's that. So next is Calmarine Foods. Bought in a lot of shares, not a lot, but enough. Balance sheet's okay. Margins are inflecting. Return on capital's inflecting. Revenues are inflecting. Cash flow is a little weak. But I think the stock had already moved a lot. And the other thing is, after they've had a move, even if it's only halfway through, you've let doubles and triples are no longer on the table. So if you're buying something that's already up a lot, yeah, so there's no dislocation here. Like, this is buying a good business at a good price, at a high price, versus we try to buy what Buffett did when he was running his partnerships and had his best performance. He bought good businesses at great prices. Once he had billions upon billions of dollars and cost-free capital, actually got paid to invest the capital, his incentive to put all that billions of dollars was part incentive, which was to just compound above his cost of capital and park it in large caps. And because you're getting 2-to-1 leverage on the surplus anyway. So he basically had a levered hedge fund with no margin costs is effectively what he did. So if he was getting 10, it's basically 20 on the leverage of the premium and the surplus. But that's a discussion for another time. When he got his best raw performance, he was doing what we're talking about, which is buying good businesses at great prices. When he made the most money was when he controlled hundreds of billions of dollars of float, and then he just parked in equities relative to fixed income because he changed the rules in Nebraska, but if you can't take a joke. But Tim A, Cal Marine, so not for us because we can't get a double or triple, and it's below our IRR target that we're targeting. This thing has been cheap for a while. I think this should not be a standalone public company. It's potato chips without any other brand. And it probably gets bought at a 20% premium to being down 80%. And you'll never hear from Utz again, other than the fact that maybe Pepsi owns it. So they've inflected cash flow positive. Revenues have been flat for 4 years. Levered balance sheet, increased the share count. Margins have compressed dramatically. It's cheap for a reason, but will it work for a trade up to 13 or 14? Yeah, probably, but that's not the game that we're in. Not a good quality business. Paul W., FDP. Del Monte Produce, no, you don't want to buy these public produce businesses. They had all the banana businesses. It's just a crappy business. Bernard C., Cal Marine, another ag business, I think. Wait, didn't we just do this one? Yeah, no, pass. John P. Depends on the sector, depends on the relative value in the sector, depends on, you value an oil company different from a tech company, different from a cyclical company, et cetera. Some of the cheapest stocks we bought were trading at 100 times earnings because they were in trough earnings at 2 cents versus $2 normalized earnings. And that's why value doesn't do well over time, because most value managers just don't have a proper framework and they're buying low multiple stocks and they just get bagged. Yeah, Andre, AI is helpful, but if you don't have the experience in the framework, you got nothing. So Jeff P, Goose still a buy here. Yeah, we like Goose. Jason Zen, TTD. This is, I think this is an advertising platform. What is this, Trade Desk? Yeah, not for us. Pass. Luigi, the only ad platform I want is PayPal. Luigi, Silator, and by the way, I know all the numbers look good. I can't discern the moat, and I think it's going to overshoot and take a lot longer time to build a base than you think. Luigi, Silator, he's asking, like, why does if in the weighing machine the price catches up to the fundamentals of BMW, why isn't it doing that in BMW and Mercedes? Because they're toast. Because their government let all these Chinese cars in and it's done. So You never want to play car manufacturers. It's a terrible business, and you got to just learn from experience to avoid certain sectors. Lars Lindfors, like airlines for the most part. Trying to see where. Yeah, here's a guy going crazy because semiconductor stocks are up. I guess he didn't have Intel with us. You just gotta chill. Like, you don't have to be involved in everything. Sooner or later, we know how the movie ends. In the meantime, we just watch and we have fun and we see it. And when the rubber band snaps back, it's going to be abrupt for them. And, you know, you'll have the powder to live another day and buy treasures from the rubble. Kleineken AG. That's from Panos. Kliniken. German company. Yeah, I don't know. I mean, look, the fundamentals look fine. Revenues have been flat for 5 years. Cash flow is doing okay, but the stock is near record highs. So, you know, if you want to trade the breakout and play that silly game, go for it. But we're not going to get a double or triple off of that. Sagar Kanakia LDOS. Lidos Holdings. Interesting. Yeah, I don't think this thing is broken enough yet. What do they do? Solutions. National security software, services, AI, machine learning, sea ground, warfighters, offensive, defense. Okay, so you're basically competing with Palantir. I have no edge on either of those stocks. For me, it's a pass. John L. Wondering how Buffett would do if he worked in hedge funds today like Citadel. AI is saying his philosophy would get him fired quickly, but is that true? Isn't there an edge to being patient? He wouldn't, because it's not his temperament to be in a day trading or high frequency trading shop. If he had a job there, he wouldn't last long because he has a different framework. So, you know, I've set my business up so I only work with people that I like, and I only work with people who understand the framework and get it. Because most people who are exceptionally wealthy made their money the same way that we're doing it here, but they did it in private markets. Whether that was rolling up a bunch of companies, whether that was buying real estate, which is an awful lot of people. And I think 90% of people, the reason that most millionaires, and, you know, when I say millionaires, I mean like centimillionaires and half billionaires, et cetera, are real estate, is because you can't sell every time there's a headline or Trump does a tweet. And I see these people sell their businesses, make $300 million, and then day trade half of it away because they think activity is productivity, like it is in the real world, and it's the exact opposite in the investing world. And sooner or later, they call someone like me because they understand that it takes a unique skill set to do it, and you got to have patience, and outperformance comes in lumps. When it comes all at once. And when, you know, there's kind of a weird exogenous chaotic situation, like a very narrow group of stocks that everyone's crowding into, you just wait for them to blow up, and that's when your stuff starts to rip higher, and you're patient, and over time you outperform, and more people send you more and more of their money, and their friends call you. But, you know, day trading and monthly performance and Sharpe ratios, all those guys sooner or later blow up. I mean, a few of them have edges. You know, Citadel has 1,000 PhDs, and they're basically scraping a cent in front of you, front running you on all your orders. That's a different business. That's not investing. That's just grifting is basically what it is. They have multi-strat. They have some intelligent pods like 0.72, but Renaissance, again, it's just scraping pennies, but doing it massively. It's a systematic computer business. It's a whole different thing. It's like a chicken processing plant. It's a different world. So the answer to your question is know what you're good at and stay in your lane and where you have an edge over time. And most of the people that think they have a short-term edge, they're going to get arbed out, by the way, with AI. And the people who have a longer-term time horizon are going to have more opportunities, because what's out of favor is going to stay out of favor longer. And when it turns, it's going to turn all at once, because everyone will chase all at the same time. So it won't look like it used to look in the past, where it would go like that. It's going to go like this and then straight up. And that's where we benefit, because we're patient. We can deal with this. We dealt with this for 2.5 years with Intel, and then straight up. That's what you're going to see more and more of in coming years. And everyone is playing in this thing where they can't think past a couple months or a couple years, and they never get these. And then what they do is, after they miss them all, they chase them up here, and then sooner or later they're out of business. So Max Hartman. Asking about VFC share count. I'm sure they got to compensate some of the new people. I'm not worried about Bracken. He knows how to manage that. He'll buy it in. Let me just see how dramatic it was. I don't see the share count going up. What, 390 to 391? I mean, come on, man. Share count's down from 447 to 391. I think you're focused on the wrong things, but thanks for sending it in. Joseph Cook. Papa John's. By the way, the reason this stuff Papa John's is up is they confirmed Brookfield Asset Management has secured the financing for the takeout. We'll see if they get taken out at 47 or not. I'm probably not going to fight that, even though it's not plan A. So if they do it, they do it. We'll make a nice gain, and we're on to the next. There are plenty of restaurant stocks to jump into, and if they don't do it, then we'll play the long game and get a lot more than that. Next, Ernest Martell, VYX for a turnaround. VYX, what do they do? No, they haven't started turning yet. Neither revenues or free cash flow are doing anything, so hard pass. Bajo. Oh, when I say it'll work as a trade, it's a short-term thing. It's going to bounce, but that's not what we do here. Love the VideoCast. Dr. Martin's DOCS. I don't know why they ever even made this shoe. It's the ugliest thing I've seen in my life. DOCS. Wait. You got the wrong ticker, partner. Oh. UK DOCS. Yeah. I should like it. I just don't want to be involved in that name. It's like, why I like VF Corp is because like I had tons of outs. So they took 2 outs. They paid down the debt. They sold Supreme and Dickies. Now they got 4 brands. The only one that's not working is Vans. And from what I saw in the stores and the cool stuff that they have now and everything that's going on and the numbers in the last call, they're going to turn it and it's going to go. Like if I got to bet on one brand, like I got to bet on just Nike or just Puma or just so-and-so, that makes me nervous. So I'm going to, because the consumer is fickle. It like comes in and comes out. No, Kraft Heinz, it's fine, but it's too levered for us. Yeah, QXO. Look, how do I feel about the compensation structure? Brad Jacobs gets a free pass from Tom Hayes because Brad Jacobs has. I don't like all the shares. I'll be candid with you, but he's issuing stock when he gets super high multiples and then buying businesses at lower multiples. So that's technically accretive. And he's just done it so many times of creating wealth for shareholders, and he's got $1 billion of his own money in. So I'm going to give him a pass on the share increase because he tends to increase business value faster than he increases share count, dramatically faster, and compound money for its owners over time. So he's probably the only operator that gets that pass. Thoughts on Zillow? Yeah, I've looked at it. This thing can't get out of its own way. Some things you got to just avoid. And if you miss them, you miss them. This one's not for us. I understand why you're looking at it, but it just hasn't worked. Alex K. So he's asking about solvency risk. Well, just do the math. What's the free cash flow? What's the debt service? What's the mature? When does the debt come due? How much do they have to refinance? Is the business growing or declining? Are they going to be in a strong position or a weak position when they have to refinance? Is it imminent? Is it out 4 or 5 years so they've got plenty of runway? And that's how you assess it. Sorry, your professor can't give you an answer on that, but if he could, he'd start his own fund and hire you. Brendan G, time to consider CMG. Yeah, I'm comfortable with CMG. I don't know if it's the exact bottom, but I think in the long term, you're in a good spot. Sprouts Farmers Market, we avoid. Supermarkets at all costs. Kareem Sabeth, amazing podcast, orthopedic surgeon, shared your podcast. SGRY, surgery centers. I tend to avoid surgery centers and hospitals. These should be private businesses. I see what you see here. Look what they've done to the share count. 49 million to 129. They're pigs. So the business has gotten better. But I can't wait to see stock-based comp on this. Hold on. This is just like that guy at Snap. Every time the business does better, he gives away all the stock-based comp to himself. So anyone that treats their partners like, you can't make a good deal with a bad person. And management that keeps diluting you without doing accretive things to increase intrinsic value per share over time, you just don't want to be partners with them. You don't have to fight them. You don't have to badmouth them. You just have to avoid them like the plague. That's the secret. What's going on here? Annual. What is going on here? Hold on. Yeah, so 36 million shares to 127 million. And where is stock-based comp? They're giving themselves 10 to 18 to they gave themselves 33 million of stock-based comp last year. So they're taking $100 million plus out of your pocket, putting it in theirs, and they wonder why the stock won't go up. That said, my man, it's probably going to work, but I'm not going to be involved. Some of these type of businesses shouldn't be public. Margins have contracted a lot. Return on capital is probably lower than their cost of capital, so that's an issue there. That said, I think it's probably going to work anyway, and we're not going to be involved. You could actually even probably get a double out of that one, but I don't have absolute certainty on that one. So we're not going to play, but I like it. Pete Bass, Following you for 3 years now. Thank you very much. UK insolvency litigation financing company. I hate that business, not for me, but I appreciate you sending that in. Ian Bernstein. Lee Foster. Adobe feels cheap. Yeah, of course, but what's your edge? Anthony, you're just guessing. It's like, what's the edge? How can you be certain that Adobe, of all things, is not going to get disintermediated by AI? Just don't play there. It might, maybe it's so good that, you know, me doing it for free on Grok is not as good as like doing it in the software, whatever it's called, Adobe, I don't know what it is, but you know, we before AI, we avoided software stocks for that reason. Anthony Ellerman. Trap versus an opportunity. Bad jockey. Bad balance sheet. Declining secular trends over time. No sign of recovery. Low, cheap for a reason. What was that one? Western Union, stuff like that. John H. FMC. FMC, yeah, I keep looking at it. That one's high risk, high reward, is my view. Yeah, turn negative free cash flow again. Revenues haven't really shown any signs of recovery. Margins continue to compress. I mean, nothing good is happening yet. Obviously, the stock price is telling you that. Share count's down a bit, but what is it? This is agricultural. Yeah, they're hurting. Farmers are hurting. I think they're losing some patents on their things, if I remember correctly. This is one you treat like a option. It could expire worthless. The beauty of this thing is it doesn't have an expiration date. So you could hold this $10 option for 10 years and maybe you'll get a 5-bagger, but this stock looks sick and you got to see some signs of recovery and you're not seeing any yet. But I definitely understand the point of view. They went through this in the early 2000s. They went through this in 2015. So it is a cyclical business. What's the balance sheet? I think that's really the key here. So we got $340 million of cash. Or let's just take last year, 584. How much debt? $5 billion on 500 million now down to 300. So that's the issue. You got to find out when all this debt matures and what's the free cash? Where is the cash flow? There it is. Negative free cash flow. That's not a good formula. 10-to-1 leverage and negative free cash flow. So again, if you treat it like an option and you're okay with expiration, fine. And if they make it through the cycle, you'll have a 5-bagger, but it's not without risk. Most undervalued, currently excluding PayPal. I think a lot of the defensives are cheap. Lulu, short. Are they ever going to turn it around or is it going to zero? It's not going to zero, but it's going to take a while. It's a broken stock. Medtronic plans to team up with NVIDIA to put out AI chips in their implantable cardiac pacemakers. Jack, I could care less about the partnership with NVIDIA, but the device makers are cheap. Baxter the best. This is probably okay, but there's not a double or triple in your future. I mean, you might just kind of match the S&P 500 returns over the next 3 to 4 years. Brad Jarrell. Starting my MBA. Roles. From a finance grad in Kentucky. Career change from healthcare, starting my MBA. I got to be honest with you. If I was a graduate, I'd be staying in healthcare. Healthcare is in the trough. This is a great time to be starting your career in healthcare. I don't know why you're switching, but and you're going to get an MBA. If you're going to be in regular business, MBA is probably useful. If you want a leadership role down the road, I think you got to just keep networking, keep sending. You'll get something, get your foot in the door. But I don't know about leaving healthcare. I think healthcare is a great opportunity right now, to be honest with you. I mean, if you're chasing into finance, if you're chasing into law, if you're chasing into a lot of these things, I like the healthcare play. And you could just roll up a bunch of nursing facilities, sell them to private equity for $300 million and retire. Lewis Calders. Readings from across the pond. Pentagon blacklist. Yeah, it's a problem, but I think it's more noise than signal. Rickard Risberg. I mean, Alibaba helping the Chinese government, Chinese military, is like Palantir helping the U.S. military. It's like AWS helping the U.S. military. Of course they're doing cloud service for the military. No shit. Like, put them on a blacklist? Okay. So it's, we'd prefer they weren't on the blacklist, but not owning the cheapest AI play in the world with the most upside and the best opportunities moving forward is not something we want to do. Will we shift the BABA shares that are not 9988 yet into 99888? We might do that again. I mean, it's unbelievable. All right. I mean, then they're going to shake hands in September at Mar-a-Lago, get nothing, but it'll be warm and fuzzy. Maybe they'll take them off the blacklist. Like, it's a good business. I want to own it. So whether I own it here in Hong Kong, most of which we own in Hong Kong, we own some here in the U.S., maybe we'll switch them over. But then we got to switch them back after they have a hug at Mar-a-Lago, so it's never ending. The key is the business good? And the answer is yes. And best positioned in the AI trade for the next 5 years. Rickard Risberg, TOM. TOM. Cash flow is declining, revenues are declining, margins are okay, return on capital is declining, probably lower than the cost of capital, debt's increasing. What do? Sensor-based solutions. Reverse vending machines. Beverage containers on behalf of beverages produced. So, again, some of these businesses shouldn't be public. This is not one that we want to be in. It's probably okay, but it's not for us. JD. Would you buy ETH here? No, we have no edge on crypto. We got involved with our friend Andrew's thing. They decided not to go ahead with it. They sent us our money back. We have no exposure to crypto. And those who were in the SPAC, once they announced they weren't going to do it, the stock went up and you could all get out then. Not something we did, something I wanted to be involved in because if I was going to and support, be involved, I want to be with the best person in the world. He was it. And he decided it wasn't the time to do it, so we didn't do it. Max Frazier, hey Tom, which positions to lead the station? Deploying money into, we're deploying money every day. We've covered them all on the media stuff. Depends on the sector, depends on the company. Bobby J. It's experience. Value trap versus not value trap. Chris Williamson. CNM, distributor for water. Wastewater, CNM. Not yet. We generally just, we're not involved in companies that haven't been public for a long time. So increased share count, cash flow decreasing, revenues flat, pass. Yeah, we covered that. Jackson. BSX, no, we covered that. Okay, so these are old ones that haven't been deleted yet. So with that said, we'll be back next week. Is going to be a shorter podcast, so get your value this week. It'll be super short next week. In the meantime, make it a great one. Bye for now.